So listen to me. When I talk about Chapter 6A, there are some preliminary points that you should be aware of before we go to the sections. Point number one, Chapter 6A is subtracted from your GTI. Point number one, I compute the GTI. It is from the GTI that I subtract Chapter 6A, and that's how I get my total income number. But point number two, we subtract Chapter 6A only against normal rate incomes. Do you remember? We've already spoken about this, right? When we, in our capital gains set itself, we've already spoken about this. We subtract GTI into, we divide GTI into two parts, the normal rate income and the special rate income. Whatever Chapter 6A we have, we subtract Chapter 6A only against normal rate income. We do not subtract Chapter 6A against special rate incomes. Special rate incomes, for example, you have your LTCG, you have section 111A STCG, you have your lottery income, your casual incomes, then you have your incomes from online games, so net winnings from online games. Against all of these special rate incomes, we don't subtract Chapter 6A. We subtract Chapter 6A only against normal rate incomes. So point number one, we subtract Chapter 6A from GTI. Point number two, we subtract Chapter 6A only from normal rate incomes and not from the special rate incomes. Point number three, now within Chapter 6A, we also have Chapter 6A Part C sections. Now, Part C sections are many in number, but we will be learning only three Chapter 6A Part C sections, which are Section 80GGAA, Section 80QQB, and Section 80RRB. Only these three Chapter 6A Part C sections are in our syllabus. Now, Chapter 6A Part C sections, the unique point about them is that these sections, the deduction will be allowed only if the assessee files his income tax return within Section 139(1) due date. The other sections, even if the assessee files his ITR late, I will still allow the deduction to him. Okay, other sections, even if the assessee files his ITR late, I will still allow the deduction to him. Only Chapter 6A Part C sections, only these deductions we will allow the assessee only if the assessee has filed ITR within 139(1) due date. Other sections, even if the assessee has filed the ITR late, I will still allow the Chapter 6A deduction. Till here clear? Yes, these were our preliminary discussions, three preliminary discussions under Chapter 6A. Point number one, Chapter 6A is allowed against GTI. Point number two, Chapter 6A is allowed only against normal rate income and not against special rate incomes. And point number three, if you have Chapter 6A Part C deductions, these deductions I will let you enjoy only and only if your assessee has filed his income tax return within the 139(1) due date. Okay. Now, under the Chapter 6A discussion, our very first discussion is going to be about the Section 80C series. Now, in 80C series, you will be learning about Section 80C, Section 80CCC, you will be learning about Section 80CCD, you will be learning about 80CCE, and finally, you will be also learning about 80CCH. So, 5 sections you will be learning about under the 80C series. Let's take them up one by one. First of all, let's focus on Section 80C. Now, Section 80C, point number one, it is allowed only if the assessee happens to be an individual or a HUF. It is allowed only for individual and for HUF. And what are the eligible payments or the eligible investments under Section 80C? So, point number one, it is allowed only for individual and HUF. Point number two, we are seeing what are the eligible payments. Listen carefully, this is extremely important, the main part of Section 80C. Number one, if the assessee is making payment of any life insurance premium he can pay for himself, or he can pay for his spouse, or he can pay for his children. Self, spouse or children, it will be allowed under Section 80C. So our first learning is about Section 80C. 80C is allowed only for individual and HUF. Number one, we have life insurance premium over here. Life insurance premium I can pay for self, spouse or for children. Now, children over here may be married, unmarried, dependent, independent, minor, major children, my own children, my adopted children, doesn't matter. We don't have any restriction on children over here. So, point number one, we will allow life insurance premium. But how much life insurance premium will we allow? That depends upon when was the policy taken. See, if the policy was taken on or before 1st April 2012, then maximum 20% of the sum assured is what we will allow. If the policy was taken No, one second, one small correction. If the policy was taken before 1st April 2012, maximum 20% of sum assured is allowed. If the policy is taken on or after 1st April 2012, maximum 10% of sum assured is allowed. If the policy is taken on or after 1st April 2013 on the life of a person who is suffering from a disability, either he is suffering from a disability or he is suffering from a disease. Either he is suffering from disability as mentioned in section 80U or he is suffering from a disease mentioned in section 80DDB, then in that case maximum 15% of sum assured is what we will allow. Okay, now do you remember in your IFOS discussion, we had also spoken about a new point with respect to 5 lakh limit. If the policy is taken on or after 1st April 2023, we have the 5 lakh limit. Now, the 5 lakh limit is not going to bother us in Section 80C. Section 80C, this is it about a discussion with respect to life insurance premium. I can pay life insurance premium on the life of whom? On the life of self, spouse or children. This is if my assessee happens to be an individual. If my assessee happens to be a HUF, HUF can pay life insurance premium on the life of any member of the HUF. Okay. If I'm an individual, I can pay life insurance premium on the life of myself or my spouse or my children. If I'm a HUF, I can pay life insurance premium on the life of any member of the HUF. How much life insurance premium maximum will be allowed depends upon the date of the policy. So we'll have to see what is the date of the policy, when was the policy taken. If the policy was taken before 1st April 2012, then maximum 20% of sum assured will be allowed. If the policy was taken on or after 1st April 2012, maximum 10% of sum assured will be allowed. And if the policy is taken on or after 1st April 2013 on the life of a person who is either disabled under Section 80U or is suffering from a disease mentioned in Section 80DDB, then maximum 15% of sum assured is allowed. Point to be noted, for this 1st April 2013, I am not saying that assessee has to be disabled. I am saying we'll see on whose life is the policy taken. On whose life is the policy taken. If that person happens to be disabled or is suffering from a disease, then the limit is going to be 15% of sum assured. Okay, so this was our first discussion under Section 80C, which is life insurance premium. Then coming to our second point, in our second point, we're talking about something called as non-commutable deferred annuity. If my assessee is making a payment towards non-commutable deferred annuity, even this can be in the name or on the life of, even this can be on the life of self, spouse or children of the assessee. Not a very important point. So any non-commutable deferred annuity on the life of self, spouse or children, even this will be allowed under Section 80C. Then if the assessee is going to make any contribution, assessee's own contribution to statutory provident fund or towards recognized provident fund, even this fits under Section 80C. Then assessee can also make a contribution to PPF, and even this can be in the name of assessee's self or spouse or children. All right. Then comes our next point, our fifth point under Section 80C. Assessee can also make his own contribution towards superannuation fund. I'll put it over here itself. Then if the assessee makes a contribution towards NSE, National Savings Certificate, if assessee subscribes to NSE, National Savings Certificate, either the 8th issue or the 9th issue, even this fits under Section 80C. Then number 6, if assessee makes any contribution to the Sukanya Samriddhi scheme. Now, Sukanya Samriddhi scheme is a scheme wherein the assessee saves money in the name of a girl child, either the assessee's own daughter or any other girl child for whom the assessee happens to be legal guardian. So, assessee can simply open the Sukanya Samriddhi account in the name of some girl child, all right, and whatever assessee contributes to Sukanya Samriddhi scheme is going to help the assessee enjoy Section 80C deduction. Now, from this Sukanya Samriddhi scheme, whatever interest we earn from the Sukanya Samriddhi scheme, that's going to be fully exempt from tax. And later, if the assessee withdraws any money from Sukanya Samriddhi scheme, even that is going to be fully exempt from tax. So, if the assessee makes a contribution to Sukanya Samriddhi scheme, assessee will get 80C deduction. And later, whenever assessee earns any interest from this account, that interest will be exempt. And when the assessee withdraws money from here, even that's going to be fully exempt. Then number 7, assessee can also make a contribution towards unit linked insurance plan, which is popularly called as ULIP, unit linked insurance plan. Even this can be in the name of assessee himself or his spouse or his children. Then number 8, assessee can also make a contribution. Assessee can buy units of a mutual fund or units of UTI under the equity linked savings scheme, ELSS, which stands for equity linked savings scheme. Even this will be eligible for section 80C deduction. Then your ninth point, if assessee makes any payment to National Housing Bank, even this will be eligible for section 80C. Then if assessee is making payment of any tuition fees paid by my assessee, it should be tuition fees, it should not be development fees, it should not be donation, it should be tuition fees. Tuition fees paid to whom? Tuition fees paid to a school, or tuition fees paid to a university, or tuition fees paid to any college, or paid to any educational institute. This tuition fees should be paid for full-time education. Where is the education happening? The education is happening in India. School, university, educational institute for full-time education in India for maximum 2 children. This will also be allowed under section 80C. For a moment, let's stop over here and tell me, where else do you have this 2 children limit? In income tax, in your syllabus, you have the 2 children limit only in 3 places, guys. Number 1, for children education allowance and children hostel allowance, maximum 2 children. Then number 2, LTC, leave travel concession, even there you talk about maximum 2 children. And the third place is over here, tuition fees is allowed for maximum only 2 children. Any other place in income tax, if you see, you don't have the 2 children limit at all. 2 children limit is only in these 3 places. Coming back to our discussion now, point number 11, if the assessee has paid any stamp duty, if the assessee has paid any stamp duty or any registration fees at the time of transfer of house property, at the time of purchase of the house property, when the assessee is purchasing a house property, if the assessee pays any stamp duty or any registration fees, even that is allowed under section 80C. All right, at the time of purchase of a house property, if the assessee pays any stamp duty or registration fees, that is also allowed under section 80C. It has to be a residential house property, however. Then comes point number 12. If the assessee has made payment, if the assessee has repaid principal repayment with respect to house property will also be allowed under 80C. There are conditions. Condition number 1, it has to be a residential house property which is assessed to tax under the head IFHP. Condition number 2, who is the lender of money? The lender has to be either the central government or the state government, or the lender can also be LIC, or the lender can be a bank, or the lender can be the National Housing Bank. Lender can also be an employer. Condition number 3, why did you borrow the loan? You had borrowed the loan for purchase or construction of the property. If all these conditions are fulfilled, then the principal repayment will be allowed under section 80C. All right. Then comes your next point, the 13th point. If the assessee makes a fixed deposit, also called as a term deposit, also called as time deposit, also called as tax saver deposit. If the assessee makes an FD for at least 5 years, where is the assessee making this FD? Either the assessee is making this FD in a scheduled bank, or this assessee is making this FD in a post office. Okay. So 3 conditions. It has to be an FD. The FD has to be for how many years, guys? The FD has to be for at least 5 years. And where is this FD being made? In a scheduled bank or in a post office. If all these conditions are fulfilled, whatever the amount is depositing in the FD, whatever amount is being deposited in the FD, assessee will enjoy section 80C deduction. Then number 14, if the assessee is going to subscribe to bonds of NABARD, even this will be eligible for section 80C deduction. And then the 15th point, second last point, if the assessee is making any contribution to the senior citizens savings scheme, senior citizens savings scheme, Even this will be eligible for Section 80C. And finally, if the assessee happens to be a central government employee and if he is making a contribution to Tier 2 of something called as NPS scheme, Tier 2 account of the NPS scheme, National Pension Scheme, then even this will be eligible for 80C, central government employee plus contribution to Tier 2 account of NPS. So these are your 16 points which are eligible for Section 80C deduction. Now see, do you have to sit and memorize this entire list? Of course not. We just have to familiarize yourself with this list in such a manner that if any of these adjustments arrive in your question paper, you should be able to link them with Section 80C. Okay. See, we're talking about Chapter 6A. Under Chapter 6A, point number 1, we've learned that Chapter 6A is something which you will adjust against GTI. Then you've learned that Chapter 6A is adjusted only against normal rate income. Then Chapter 6A Part C deductions. Chapter 6A Part C deductions I will allow for you only if you happen to file your ITR within 139(1) due date. But other sections under Chapter 6A, even if you file your ITR late, you can still enjoy the Chapter 6A deduction. Now we are focusing on Section 80C first. Under 80C, assessee can be an individual or a HUF, and all of these 16 points are your eligible deductions under Section 80C. Now, what are these eligible deductions under 80C? Point number 1, if you're going to make payment of life insurance premium, now life insurance premium you can pay for whom? Life insurance premium you can pay for self, spouse or children. For self, spouse or children, and if you're the HUF, you can pay for on the life of any member. Life insurance premium, however, we have limits. If the policy was taken before 1st April 2012, maximum 20% of sum assured. If the policy is taken on or after 1st April 2012, maximum 10% of sum assured. If the policy is taken on or after 1st April 2013 on the life of a person who is either disabled or suffering from a disease, maximum 15% of sum assured. This is what's going to be allowed under Section 80C. Then, if the assessee makes payment towards non-commutable deferred annuity, again in the name of self, spouse or children, even this will be eligible for Section 80C. Then if assessee makes a contribution to statutory provident fund or recognized provident fund or superannuation fund, or if assessee makes a contribution towards PPF, again in the name of self, spouse, children, or if assessee makes a contribution towards NSC 8th issue or NSC 9th issue, or if assessee makes a contribution to Suganya Samriddhi scheme in the name of whom? This has to be in the name of a girl child. This girl child will either be the assessee's own daughter or any other girl child for whom the assessee is a legal guardian. Even this contribution will be eligible for 80C. Later, if you receive any interest from this scheme, it's fully exempt. And when you withdraw money from the scheme, also it is fully exempt. Then any investments in unit-linked insurance plan, this also can be in the name of self, spouse, children, will be eligible for 80C. Then if assessee buys mutual fund units or UTI units, under ELSS, even this will be eligible for Section 80C. Assessee contributes to National Housing Bank, eligible for 80C. Tuition fees for maximum 2 children will be allowed, provided it is for towards school, university, college or educational institution for full-time education in India. Then stamp duty registration fees paid will also be allowed under 80C. Principal repayment of a residential house property which is assessed to tax under IFHP. Lender should be any of these, and the loan should be used for purchase or construction of the property. This will be allowed under 80C. Principal repayment, 3 conditions. Then finally, we spoke about any FD, term deposit, time deposit or tax saver deposit. They are all the same. If it is made for at least 5 years in a scheduled bank or in a post office, even this will be eligible for 80C. Then if assessee subscribes to NABARD bonds or makes a contribution to the Senior Citizen Savings Scheme account, or if the assessee happens to be a central government employee, and if he is making contribution to Tier 2 of NPS account, this will also come to 80C. See, NPS is National Pension Scheme. This has Tier 1 account and Tier 2 account. The Tier 1 account goes to 80CCD, which we will be discussing a little later. Tier 2 comes under 80C. Tier 1 80CCD, Tier 2 80C, but Tier 2 is only for central government employee. These are your 16 points. Now listen, some important points which you have to understand. Under this discussion. Listen carefully. Point number 1, you have to remember that ULIP and ELSS, Equity Linked Savings Scheme, and ULIP, Unit Linked Insurance Plan, both will come under 80C. These are important points. Generally, students forget about them in the examination. Another important point which you should remember, ATC, all the investments, all the contributions have to be in assessee's own name only. Like, for example, if the assessee is making an FD, it has to be in assessee's own name only. Where is it allowed to be in others' name also? Like, for example, where and all is self, spouse, children allowed? Like in life insurance premium, self, spouse, children is allowed. Even in PPF, self, spouse, children is allowed. Even in ULIP, self, spouse, children is allowed. And one more point we had seen in between, remember, non-commutable deferred annuity. In these four places, the contribution can be in the name of self, spouse, children. What are the four, guys? Life insurance premium, PPF, ULIP. Then in the name of assessee's girl child, we had one point over here, the Suganya Samriddhi scheme. Suganya Samriddhi scheme was in the name of the girl child. Then we had one more point, which was tuition fees. Tuition fees can be for two children of the assessee. So apart from these three, apart from these adjustments, everything else under ATC has to be in assessee's own name. These points can be in others' names also, but everything else, like for example, if assessee is buying, if assessee is making a contribution to National Housing Bank, it has to be in assessee's own name. If assessee is buying mutual fund units under ELSS, it has to be in assessee's own name. If assessee is making principal repayment of a housing loan, again it has to be in assessee's own name. Are you understanding? So everything else has to be in assessee's own name. Only and only these contributions and investments can be even in others' names. Life insurance premium, PPF, ULIP, and non-commutable deferred annuity. These four can be in the name of self, spouse, children. Suganya Samriddhi scheme will be in the name of assessee's girl child. And tuition fees will of course be in the name of two children of the assessee. Everything else has to be in assessee's own name. Only these are allowed to be in others' names as well. So this was our discussion on section ATC. I'm not going too much in depth because not required. We're doing it entirely from the exam point of view. So this was section ATC, your first section under the ATC series. Now coming to your second section under the ATC series, which is section ATCCC. Now section ATCCC, this section is applicable only and only to individuals. The assessee has to be an individual. We're not even covering HUF, we're only talking about individuals. Now, what is the eligible payment under ATCCC? We have only one payment under ATC, only one under ATCCC, only one contribution under ATCCC. See, if the assessee is making any payment, any amount which the assessee is making, any amount which assessee is paying towards annuity plan of LIC. If assessee is making any payment towards annuity plan of LIC or any other insurance company. Now, why is the company making this payment? What does the company want from LIC later? What does the company want? What does the assessee want from LIC later? What does the assessee want from the insurance company later? The objective is later the assessee wants to receive pension. So the assessee is making payment towards an annuity plan of LIC or insurance company. Why is the assessee making a payment towards annuity plan of LIC or insurance company? Because later the assessee wants to receive pension. Now this contribution, this is what the assessee will enjoy under ATCCC. Any payment made towards annuity plan of LIC or any other insurance company, this will help the assessee avail ATCCC deduction under Chapter 6A. Now later, what is the assessee going to receive? Pension. Now, when the assessee receives this pension from this annuity plan of LIC, this pension is going to be fully taxable for the assessee. Okay, later when the assessee receives pension, see, it's like this. While I'm working, I'll save money for my retirement by making contributions towards this annuity plan of LIC. When I retire, I will expect this insurance company to give me pension. When I make the payment to the plan, I'll get ATCCC deduction. Later, when I receive pension from this plan upon my retirement, this will be taxable for me. This is ATCCC, a small, simple section. Okay, then we have section ATCCD. This is your third section under your ATC series, ATCCD. In ATCCD, who is your assessee? Here also your assessee has to be only an individual, and we have only one eligible payment over here, which is contribution to National Pension Scheme, which is also called as the Atal Pension Yojana. Contribution to National Pension Scheme, which is also called as Atal Pension Yojana. Now, listen carefully to help you understand this. I'm going to draw a proper flow chart to help you understand this. Listen carefully. See, under your national pension scheme, you have two types of accounts. You have the tier 1 account and you also have the tier 2 account. But I'm hoping this is sounding a little familiar to you. We've already spoken about this in our salaries chapter and also in our PGBP chapter. So I'm not going in depth because I've already explained to you the significance of this scheme over there. It's sort of a retirement fund, guys, wherein I save money in these funds throughout my working life. And when I retire, I get money from here to help me survive in my post-retirement life. So National Pension Scheme has two accounts, Tier 1 account and Tier 2 account. Tier 2 account goes to Section 80C, but only for central government employees. Only the Tier 1 account, only contribution to Tier 1 account comes to Section 80CCD. Okay, and Section 80CCD is for all employees, whether you're a government employee or a non-government employee, it doesn't matter. Now, under 80CCD, listen to the entire flowchart. I'm drawing this entire thing for you over here. 80CCD, the first thing that you will check is your assessee an employee or is your assessee a self-employed person? If your assessee happens to be an employee, then you will have the employee's contribution and you will also have employer's contribution. See, just like how in RPF, employee and employer both contribute into the employee's account, even in NPS, employee-employer both will contribute into the employee's account. So we have employees contribution and we have employers contribution, right guys? Now, whatever is the employees contribution, we have two sections under this. We have section 80CCD1 and we have section 80CCD1B. Section 80CCD subsection 1 and section 80CCD1B. Two sections 80CCD1 and 80CCD1B. Under 80CCD1B, maximum 50,000 rupees will be allowed. And when you look at 80CCD1, maximum 10% of salary will be allowed. Now, what do you mean by salary? How will you compute salary? Salary for the purpose of 80CCD would be nothing but your basic salary plus DA forming part, full stop. I am not considering commission. I am considering only basic salary and DA forming part. Okay. We're not considering all DA, only DA forming part, and we're not considering commission. So, employees contribution, we have two sections. We have 80CCD1 and we have 80CCD1B. Under 80CCD1B, maximum of 50,000 is allowed, and under 80CCD1, maximum 10% of salary is allowed. Now, when it comes to employers' contribution, this is where I want to sort of give you a detailed discussion, because this is where students generally go a little, they get a little confused over here. Let me discuss this with you from a 360-degree angle. Listen to me carefully, very, very carefully. See, if the employer is making a contribution, we have to think from the employee's point of view and also from the employer's point of view, guys. Let's talk about employer's point of view first, because it's simple. From the employer's point of view, don't you think it's going to be an expense? For the employer, don't you think it's going to be an expense connected to his business or profession? So therefore, it will be allowed. It will be allowed under the PGBP head. But maximum, how much will be allowed? Maximum only 10% of the employee salary will be allowed. I hope you recall this discussion in our PGBP head. We had spoken about it. For the employer, it will be allowed. But maximum, how much will be allowed? Only up to 10% of salary will be allowed. Now, if you think from the employee's point of view, for the employee, don't you think, first of all, it's an income? It's a benefit because the employer is making a contribution into the employee's account. So it's an income, it's a benefit for the employee. Therefore, it should first of all be taxable for the employee. Taxable under which head? Any benefit you get from the employer, be taxed under which head? Any benefit you get from the employer, be taxed under the salaries head, guys. So it will be taxable for the employee under the salaries head. It will be taxable for the employee. This is going to be the first tax treatment for the employee. The first tax treatment is that it will be taxable for the employee under the head salaries. In addition to this, my assessee will also get 80CCD subsection 2 deduction. So understanding employer's contribution, from the employer's point of view, if you see it's an expense for him connected to his business or profession, it will be allowed under the PGBP head, but maximum only 10% of salary will be allowed. For the employee, if you see, it's an income or a benefit which he has enjoyed from his employer. Therefore, it will be taxable under the head salaries. In addition to that, assessee will also get 80CCD 2 deduction. Now, this is what we're discussing under Chapter 6A. This is a section, right? We're talking about Section 80CCD. So, under 80CCD, employees' contribution I've already spoken about. Employer's contribution under 80CCD, that is what I'm discussing with you now. Under 80CCD subsection 2, you'll have to see over here is the employer government. When I say government, I'm talking about both central government as well as state government, or is the employer any other employer? If the employer is central government or state government, maximum 14% of salary will be allowed under 80CCD 2. If the employer happens to be any other employer, maximum 10% of salary is what will be allowed under 80CCD 2. Okay, this is 80CCD 2. This is our entire discussion with respect to employer's contribution. So, employer's point of view we've discussed. Employee's point of view we've discussed. Employee will also enjoy 80CCD 2 deduction. This is the part which is relevant for Chapter 6A. How much 80CCD 2 deduction? If the employer is central government or state government, maximum 14% of salary. If the employer is any other employer, maximum 10% of salary will be allowed. Okay. Now, what if the assessee happens to be a self-employed person? See, if the assessee happens to be a self-employed person, then there is no question of employer's contribution, guys. I'll only have my own contribution. We'll only have assessee's own contribution. We do not have any question of any employer's contribution because assessee is self-employed. So, assessee's own contribution, if you see something very similar to this, assessee's own contribution, we will have two sections over here. We will have section 80CCD1 and we will have section 80CCD1B. Same thing under 80CCD1B, maximum how much we'll allow? Same thing, maximum 50,000 will allow over here. Under 80CCD1, maximum 20% of GTI is what we will allow. This is your section 80CCD. The entire discussion on 80CCD is on your screen over here. So it all depends upon, is the assessee an employee or is the assessee a self-employed person? If the assessee happens to be an employee, then you will have employee's contribution and employer's contribution. If the assessee happens to be self-employed, you will have only assessee's own contribution. Now see, I'll give you a revision once again. But before I give you that revision, listen to this small summary first. Under section 80CCD, how many subsections are we talking about? We're talking about 80CCD1, we're talking about 80CCD1B, and we're talking about 80CCD subsection 2. Please notice that 80CCD1 and 80CCD1B is for own contribution of the assessee, and 80CCD2 is only for employer's contribution. Under 80CCD1, maximum how much do I allow, guys? If the assessee happens to be an employee, then maximum 10% of salary we allow. Listen carefully, I'm giving you a summary. And if the assessee happens to be self-employed, how much do we allow under 80CCD1? Maximum 20% of GTI we allow. Under 80CCD1B, how much do we allow here? Maximum 50,000 we allow. And under 80CCD2, how much do we allow? Maximum. By the way, here it depends upon, is the employer government or not. If the employer happens to be the government, central government or state government, maximum 14% of salary is what we allow. And if the employer happens to be any other person, then maximum 10% of salary is what we allow. Right? So this is a sort of a summary of section 80CCD. Under 80CCD1, we allow own contribution. 80CCD1B also we allow own contribution. 80CCD is for employer's contribution. And what do you mean by salary? Salary means basic salary plus DA forming part. Okay, now let's come back to this flowchart. Let's revise this flowchart one final time. If assessee happens to be an employee, then we'll have employees contribution and employers contribution. Employees contribution, own contribution, we have 80CCD1 and 80CCD1B. Under 80CCD1B, maximum 50,000 deduction you'll get. Under 80CCD1, maximum 10% of salary you will get as a deduction here. Employer's contribution, if you see, for employer's point of view, for him it's a business expense allowed under PGBP, but maximum only 10% of salary. For the employee, it's a benefit which will be taxable under the head salaries. Also, 80CCD2 deduction as employee will get. How much 80CCD2 deduction depends upon is the employer central government or state government or any other person. If central government or state government or any other person, if central government or state government, 14% of salary will be allowed. If any other employer, 10% of salary will be allowed. Then what if the assessee happens to be a self-employed person? Under 80CCD1, maximum 20% of GTI. Under 80CCD1B, maximum 50,000 will be allowed. In this, if you see, generally what I suggest to students is we always do 80CCD1B first, only then we come to 80CCD1. We always do 80CCD1B first and only then 80CCD1. Okay, so this was our discussion with respect to 80CCD contributions made to National Pension Scheme. Now listen, 80CCD doesn't end here. We have a little bit more to discuss under section 80CCD. See, don't you think a little later, when the assessee retires, okay, assessee will want to withdraw money from NPS. So when the assessee makes any withdrawal from NPS, how do you treat it? Is it exempt or is it taxable? Any withdrawal from NPS, is it exempt or is it taxable? How does it work? Listen to me. See, if the withdrawal from NPS is by the nominee of the assessee, after the assessee dies, if assessee's nominee is withdrawing money from NPS, then it's going to be fully exempt. It's going to be fully exempt for the nominee. But if the assessee himself is withdrawing money from the NPS, then it is slightly different. If the assessee himself is withdrawing money from NPS upon maturity, that is upon his retirement, when he is withdrawing money from NPS, then we will see what is the amount that he has withdrawn. See, whatever he withdraws from NPS, whatever is the balance in NPS, he should not withdraw the entire amount. Only 60% of the amount he can withdraw from the NPS. The balance 40% of the amount, he has to put this balance 40% into a pension scheme of LIC. He has to put the balance 40% into the pension scheme of LIC. And this pension scheme is also called the annuity plan. He has to put this balance 40% into an annuity plan. And from this, he is going to get periodical pension. This periodical pension that he gets, this of course is going to be taxable. All right. When we're talking about withdrawal from NPS upon maturity. If the withdrawal is by the nominee upon assessee's death, then it's going to be fully exempt. But if the assessee himself is going to withdraw from NPS, then whatever balance is there in NPS, he should not withdraw the entire amount. Only 60% of the amount he should withdraw. All right, only 60% of the amount he should withdraw, and the balance 40% he should put into an annuity plan from which he will receive pension. If he does like this, then it is going to be exempt. See, the 60% number he can withdraw fully, this is of course going to be exempt. The balance 40%, if he puts into the pension scheme, then only it is going to be exempt. If the balance 40% also if he withdraws, then the 40% number will become taxable. 60% number he can anyways withdraw. Therefore, 60% number will anyways be exempt. 40%, the balance 40% also if he withdraws, then it's going to be taxable. But the balance 40% number, if he puts into pension scheme of LIC, then it is going to be exempt for him. From this pension scheme, he will get periodical pension, which is going to be taxable. Okay, so this was your entire discussion on 80CCD. The last part, I hope you've understood. If the nominee is going to withdraw money from NPS, then it's going to be fully exempt. If the assessee is himself going to withdraw from NPS, only 60% of the money he should withdraw, he will enjoy exemption. Balance 40%, if he withdraws, it will become taxable. If he wants the exemption of this 40% number also, he has to reinvest it into annuity plan and get pension from this annuity plan, which is going to be taxable. So under 80CCD, this withdrawal part, I will give you one final revision of this. This is a little tricky. See, if the nominee if the assessee dies, and if the nominee receives money from NPS, for the nominee that money is going to be fully exempt. Whatever the nominee has received from the NPS is going to be fully exempt. Okay, but if the assessee himself, upon maturity, if he withdraws money from NPS, how much can he withdraw? Whatever corpus, whatever amount, whatever balance is there in NPS, can he withdraw it fully? No. Only 60% he can withdraw. If he withdraws the 60%, that's going to be exempt for him. What will he do with the balance 40%? Can he withdraw this balance 40%? No. He will have to put this 40% into an annuity plan from which he will receive pension. Are you understanding? From the NPS, when the nominee withdraws whatever is there in NPS, it's going to be fully exempt for the nominee. When the assessee himself withdraws from NPS, he can withdraw only 60% of the amount. And this 60% of the amount which he has withdrawn will be fully exempt for him. What about the balance 40%? The balance 40% he can't withdraw. The balance 40% he has to transfer into annuity plan. From this annuity plan, what will he receive? Periodical pension he will receive. If he does this 60% is anyways exempt. 40% which he did not withdraw and put into the pension scheme, even this will be exempt. From this 40% he will receive periodical pension. That is going to be taxable. Now did you understand? Yes, the 60% he can withdraw, that is going to be exempt. 40% he can't withdraw. 40% he will put into annuity plan, which if he puts into annuity plan like this, even this 40% will be exempt. So 60, 40, total 100, entire amount in the NPS will be exempt like this. If you withdraw 60 and balance 40, you put into annuity plan. Then from this annuity plan, you will get periodical pension. That pension is going to be taxable. All right. Now, do you remember you were receiving pension under 80CCC also? This pension was also taxable. Even from 80CCC, whatever pension you get, even that is going to be fully taxable. Even under 80CCD, whatever pension you get, even that is going to be fully taxable. Got it? Okay, now with this, we've understood the first three sections. We've understood 80C, 80CCC, and 80CCD. Now let's go to our fourth section under the 80C series, which is section 80CCE. Simple section, guys. 80CCE says that 80C plus section 80CCC plus section 80CCD subsection 1 put together, maximum how much deduction you can get? Maximum only 1,50,000 you can get. You're well aware of this. I've discussed this with you in multiple places already. So 80C plus 80CCC plus 80CCD1. Are you noticing? Does this limit also cover 80CCD1B? No. Does this limit also cover 80CCD2? No, we are covering only 80C, CCC, and in 80CCD, only subsection 1, not 1B, not 2, only subsection 1. Put together, this should not exceed 1,50,000. Crystal clear, everybody. This is 80CCE. It is this section which says that 80C plus CCC plus CCD1 put together should not exceed 1,50,000. All right. And your final section under the 80C series, which is section 80CCH. Now, section 80CCH talks about contributions which are made to the Agnipath scheme. Contributions which are made to the Agnipath scheme. Let me explain this to you. I'll bring the theory with respect to this on your screen because this is a new section brought in by the Finance Act 2023. So let me bring the whole section itself to your screen and we'll discuss the theory of this section part by part. Look at this, please. 80CCH, which talks about contributions which are made to the Agnipath scheme. Now, what is this Agnipath scheme? It is a scheme of the central government launched in 2022 for the enrollment of Indian youth in the Indian Armed Forces. The Agniveer shall contribute 30% of his monthly customized Agniveer package to his Agniveer Corpus Fund. Central government also shall make a matching contribution to the fund. See, the Agnipath scheme is a scheme brought in by the government to encourage the Indian youth to join the Indian Army. I'll repeat again, Agnipath scheme was a scheme brought in by the Indian government to encourage Indian youth to join the Indian Army. Under the Agnipath scheme, the Agniveer is basically that Indian youth who's joining the Indian Army. Under this scheme, we call that person who's joining the Indian Army as the Agniveer. So this Agniveer, the army man, the person who's joining the Indian Army, this Agniveer and the central government both will make contributions to the Agniveer Corpus Fund. Just like how to RPF, employer both contribute. Just like how to NPS, employer both contribute. Similarly, to the Agniveer Corpus Fund, employee, who is the employee over here? The youth, the Indian youth who's joining the Indian Army, that is the Agniveer. This Agniveer and the central government both will contribute. The Agniveer and the central government both will contribute. Now listen. Whatever is the Agniveer's own contribution, that will be eligible for 80CCH deduction. Whatever is the central government's contribution, that will be eligible for 80CCH subsection 2 deduction. Later, whatever money is received from the Agnipath Corpus Fund, that's going to be fully exempt from tax. So over here, if we have to simplify this a little bit for us, we have the Agniveer Corpus Fund, ACF, the Agniveer Corpus Fund. Now, who will contribute into this Agniveer Corpus Fund, guys? The Agniveer, that is the Indian youth who is joining the Indian Army, the Agniveer, he is going to make a contribution here, and also the central government will also make a contribution here. So, two people will contribute, the Agniveer will contribute, and even the central government will contribute. Whatever the Agniveer is contributing, that will be eligible for 80CCH1 deduction. Whatever the central government is contributing, this will be eligible for 80CCH2 deduction. So how many contributions we have over here? We have two contribution, the Agniveer's contribution and the central government's contribution. See, in this discussion over here, who is my assessee? It is the Agniveer who is my assessee. So we have his own contribution and the central government's contribution. His own contribution he will get as a deduction under 80CCH1, guys. Whatever he's contributing under 80CCH1, it will be taxed for him. Whatever the central government is contributing, don't you think first of all it's a benefit for the Agniveer? Come on, tell me, whatever the central government is contributing into his corpus fund is a benefit for the Agniveer, guys. Whatever money is accumulated in RPF, who enjoys? Employee. Whatever money is accumulated in NPS, who enjoys? Employee. Whatever money is accumulated in Agniveer Corpus Fund, who will enjoy? The Agniveer. So who is benefiting from the central government's contribution? The Agniveer is benefiting. So whatever is the central government's contribution to the Agniveer Corpus Fund, it's first of all a benefit for the Agniveer, and therefore it will be taxable for him. Taxable under which head, guys? Taxable for him under the head salaries. Because for the Agniveer, the central government will be his employer. So any benefit you get from the employer will go to the salaries head. So even over here, the benefit I will tax it under the head salaries. Don't you think this is exactly what we did even in 80CCD? even in 80CCD, the employer's contribution for the employee, the employer's contribution, we tax it under the salaries head. We said for the employee, it's an income or it's a benefit which the employee has enjoyed from the employer, which we will tax it under the head salaries. So the employer's contribution for the employee, we had taxed it under the head salaries. Exactly in the same manner, even under 80CCH, whatever is a central government's contribution for the Agniveer, it's a benefit from his employer, which we will tax under the head salaries, and then we will also give him 80CCH subsection 2 deduction. That's all. That's all, guys. So Agniveer's own contribution under 80CCH1, he'll get a deduction. Whatever is the central government's contribution, it will first be taxed under the head salaries, and then under 80CCH subsection 2, you will get a deduction. Now later, from RPF also, upon retirement, employee withdraws money. Later, from NPS also, the employee withdraws money. So later, whatever money got accumulated in this Agniveer Corpus Fund, Agniveer's contribution, central government's contribution, whatever got accumulated over here, later the Agniveer will withdraw from here, guys. Whatever amount he withdraws from this Agniveer Corpus Fund, what is the tax treatment? Any amount withdrawn from the Agniveer Corpus Fund will be fully exempt from tax. In this entire discussion, who was the assessee? The Agniveer was the assessee. New section, newly introduced by Finance Act 2023. I hope you understood this. Just remember this part of the discussion. This summarizes the entire section. So what is this Agniveer? What is this Agnipath scheme? The Agnipath scheme is a scheme launched by the central government to encourage the Indian youth to join the Indian Army. Under this Agnipath scheme, we have the Agniveer Corpus Fund. To this Agniveer Corpus Fund, the Agniveer will also make a contribution. The central government will also make a contribution. The Agniveer's own contribution will go to 80CCH subsection 1. Central government's contribution will first be taxed under the head salaries, and then it will go to 80CCH subsection 2. Whatever amount we withdraw from I guess I was not audible in the last part. So I'll just give you one quick summary once again. So I was telling you that whenever you withdraw money from the Agniveer Corpus Fund, it's going to be fully exempt. So to the Agniveer Corpus Fund, the Agniveer will contribute. Even the central government will contribute. Agniveer's contribution under 80CCH1 will be allowed. Central government's contribution will first be taxed under the head salaries for the Agniveer. It will first be taxable under the head salaries, and then under 80CCH subsection 2, it will be allowed. See, here there are no limits. Whatever is the contribution, it will be fully allowed. Whatever the Agniveer contributed into the fund, 80CCH 1 deduction. Whatever the central government contributed, it will first be taxed under the head salaries, and then fully allowed under 80CCH subsection 2. Then, whatever amount from the Agniveer Corpus Fund the Agniveer later withdraws, the entire amount withdrawn from the Agniveer Corpus Fund will be fully exempt from tax. Whatever amount is withdrawn from the Agniveer Corpus Fund by the Agniveer, this will be fully exempt from tax. So with this, you've learned all your 5 sections under the 80C series. You've learned about 80C, you've learned about 80CCC, you've learned about 80CCD, you've learned about 80CCE, and you've learned about 80CCH. 80CCH was a new section under the Finance Act 2023, but it is not complicated. This is the only part about it which is relevant for us. Even the Agniveer will contribute, even the central government will contribute. Agniveer's contribution will go to ATCCH subsection 1. Central government's contribution will go to ATCCH subsection 2, and later when you withdraw the money, it's going to be fully exempt from tax. That's all. So this is it about our discussion on the 5 sections under the ATC series. So starting off with our discussion on the ATD series, over here we have 3 sections only. We have section ATD, we have section ATDD, and then we have section ATDDB. Okay, and out of these 3 sections, the most important out of these 3 sections is the very first one, which is section ATD. So let's talk about that section ATD. Now, section ATD covers various transactions. Let's go one by one. First of all, who is your eligible assessee over here? This is how we learned even the other sections, right? We always start by saying who is the eligible assessee. So under ATD, the eligible assessee is individual and HUF. Now, which other section did you have individual and HUF? Do you recall? See, ATC, even in ATC, we spoke about individual and HUF. Remember, ATCCC was only for individuals. ATCCD was also only for individuals. ATCCH was also for only individuals. Apart from ATC, no other section was individual and HUF. ATD again is applicable to individuals and HUFs. All right. Then listen to the second point. Under ATD, there's a special unique point about the mode of payment. Irrespective of the amount, irrespective of what amount you're making payment, the payment has to be made only in non-cash mode. You did not have this point in any of the ATC series. In ATD, you have this. In ATD, you have this, that whatever amount you're making payment, it has to be paid in non-cash mode only, irrespective of the amount. Only then you will even consider it. Okay. Now see, assessee can make payment towards what? Assessee can make payment towards medical insurance premium over here, or assessee can also make a contribution to the central government health scheme, or the assessee can also make payment towards preventive health checkup, or in case the assessee happens to, or in case there's a person who's senior citizen or a super senior citizen in whose name there is no medical insurance policy, we can also cover medical expenses. So under section ATD, the 4 adjustments or the 4 transactions which are covered are: number 1, medical insurance premium; number 2, contribution to central government health scheme; number 3, preventive health checkup; and number 4, medical expenses. See, let's talk about this one by one. Now, let's say my assessee is an individual. If my assessee is an individual, my assessee can make these contributions. Either he can make this contribution for his family, or he can make this contribution for his parents. So we're dividing into 2 parts, family and parents. Now, family will include 3 people only. Family will include self, spouse, and dependent children. See, if you remember, in section ATC, we spoke about all children, whether dependent or not does not matter, guys. But under ATD, we are talking only about dependent children. Okay. So under the family category, you have 3 people. You have self, you have spouse, and you have dependent children. Under the parents category, you have parents of the assessee. We're not talking about parents of assessee's spouse. We're only covering assessee's parents. Whether they are dependent or not dependent does not matter. Dependent is a point which we're talking about only with respect to children. Assessee's children, they have to be dependent on him. Parents of the assessee may be dependent or not dependent, doesn't matter. So the reason why we have split into 2 categories is because for each category we have a separate limit. Like for family category, we have the maximum limit of 25,000. Similarly, even for parents category, we have a maximum limit of 25,000. Okay. But in the family category, if even one person in the family category happens to be a senior citizen or a super senior citizen, then the limit of the family category will increase to 50,000. Similarly, in the parents category, if even one person happens to be a senior citizen or a super senior citizen, the limit will immediately increase to 50,000. So we are giving separate limit to each of these categories. Family category, the limit is 50,000 or 25,000. Parents category, also the limit is 25,000. But in the family category, even if one person happens to be a senior citizen or a super senior citizen, the limit will increase to 50,000. Similarly, in the parents category, even if one person happens to be a senior citizen or a super senior citizen, the limit will increase to 50,000. Okay, guys. So this was your very first point, that under Section 80D, the assessee has to be an individual or HUF, and all these payments have to be made in non-cash mode except preventive health checkup. Now, preventive health checkup, when assessee is making the payment towards preventive health checkup, this can be paid in any mode, not necessary it has to be paid in non-cash mode. Preventive health checkup can be paid in any mode. And one more point about preventive health checkup is that preventive health checkup, maximum limit of preventive health checkup which is allowed is 5,000 only. So we have the overall limits of 25,000 and 50,000. Within this, the total preventive health checkup for the family category, for the parents category put together, the total preventive health checkup should not exceed 5,000. Maximum only 5,000 is allowed. Understanding, everybody? So for preventive health checkup, we have two special points. Point number one, the payment can be made in any mode. And point number two, the maximum limit is 5,000 rupees. We have category limits of 25,000 and 50,000 as the case may be. But within preventive health checkup, family parents put together should not exceed 5,000 rupees. Okay. So assessee can be individual or HUF. All payments have to be made in non-cash mode except preventive health checkup. This can be paid in any mode. Under 80D, we are covering payment of medical insurance premium. We are covering payment towards central government health scheme, payment towards preventive health checkup and medical expenses. Now, if the assessee happens to be HUF, we don't have family, parents and all. In HUF, we'll just cover all the members of the HUF. So if the assessee happens to be HUF, we can pay medical insurance premium on the name in the name of any member of the HUF. So if assessee is individual, we're covering family and parents. Understanding, everybody? If the assessee happens to be individual, we are covering over here family and parents. The payments can be made in the name of family or parents. If the assessee happens to be HUF, the payments can be made in the name of any member of the HUF. The payment can be made in the name of any member of the HUF. Okay. The payment has to be made only in non-cash mode. We can make payment of medical insurance premium, or we can make a contribution towards central government health scheme, or we can also pay towards preventive health checkup. Preventive health checkup we can pay in any mode, and family, parents put together preventive health checkup should not exceed 5,000. Now listen to the next point. Let's focus a little more now on this part about medical expenses. See, when are we going to cover medical expenses? We will cover medical expenses only if, for example, let's say assessee's father. Assessee's father, let's say, just an example, okay? The person can be any person in the family category, any person in the parents category, any person either in the family category or in the parents category. That person is a senior citizen or a super senior citizen, okay? And in his name, there is no medical insurance policy. There is a person, he is a senior citizen or a super senior citizen. He falls under any of these categories. He is a senior citizen or he is a super senior citizen. And in his name, there is no medical insurance policy. Now, for him, there is no medical insurance policy. Now, for him, whatever medical expenses we incur, this will be allowed for us under Section 80D. The medical expenses will be allowed under 80D. But did you understand that when will medical expenses be allowed? Medical expenses will be allowed only and only if the person in these two categories, any person in these two categories, happens to be a senior citizen or a super senior citizen and does not have a medical insurance policy in his name. Then whatever medical expenses we have incurred for him, that we will allow under Section 80D. So this was our entire discussion with respect to Section 80D. We just have only one point left over here. Till here, do you have the clarity? Yes, the limit is 25,000, but even if any one person in that particular category, if it happens to be a senior citizen or a super senior citizen, then the limit will exceed to 50,000. Now we have the exact same limit for HUF also. Even for HUF, even if the assessee happens to be HUF, the maximum limit will be 25,000. But even if one member of the HUF happens to be a senior citizen or a super senior citizen, for the HUF itself, the limit will increase to 50,000 rupees. Understanding, everybody? So if your assessee happens to be a HUF, the assessee can make payment towards the members of the HUF. And what are the limits over here? Even for HUF, the limit is going to be 25,000. Even if any one member of the HUF happens to be a senior citizen or a super senior citizen, then for HUF, the limit will increase to 50,000 rupees. Understanding, everybody? Yes, you see here, the medical expenses point is very important. When are you going to cover medical expenses point? You'll cover medical expenses point only if the persons covered in these categories happens to be senior citizen or super senior citizen, and in his name you don't have a medical insurance policy. Now for him, whatever medical insurance premium we are paying, that will be allowed under section 80D. Understanding. Then after this, one final point, understand one last point under section 80D. See, today if you see, it's very common practically that whenever, let's say I buy a medical insurance policy, they'll let me pay the premium lump sum for multiple years together. So we have this concept of lump sum payment of premium. So I've paid lump sum premium for, let's say, 5 years. Now, if I've paid lump sum premium for 5 years, how will you allow the deduction of the premium? Of course, you will allow it proportionately. Now, here, if I say 5 years, your most obvious answer will be that, okay, fine, whatever premium we've paid, we will allow the premium across 5 years. That is what your most obvious answer will be, but it doesn't work like that. Listen to me, I'll give you some examples, you'll understand. Let's take our first example. See, if the policy, if let's say the date of policy is, let's say, 1st September 2023, and I've taken the policy for 3 years, okay, and we have paid lump sum premium, of let's say 1 lakh rupees. Now, just because I have taken the policy for 3 years, you will not divide 1 lakh by 3 and say, okay, 333 we will allow across each year totally for 3 years. Doesn't work like that. See, the date of the policy is 1st September 2023. So what's going to be the period of the policy? 1st September 2023 to 2024 1 year, then 24 to 25 second year, and 25 to 26 third year. So this policy is going to expire on 31st August 2026. This is going to be your 3 years period, guys. Are you all following? This is going to be your 3 years period. Now, this 3 years period is touching upon which previous year? This 3 years period is touching upon, if you see, it's touching upon previous year 23-24. It's touching upon previous year 24-25, previous year 25-26, and previous year 26-27. Right, guys? So the policy is touching upon 4 previous years. So what you will do is your section 80D deduction is going to be 1 lakh rupees divided by 4. You're understanding? You will see how many years has the policy touched upon. I mean, just because the policy is for 3 years, you will not divide it by 3. You will see the policy is touching upon how many years, and for those many years, you will proportionately divide the premium. So 1 lakh divided by 4, 25,000 per annum, you will get as a deduction under section 85D. Per annum for these 4 years. For these 4 years, you will get a deduction. 25,000 per year, you will get a deduction for 4 years. Tell me this, did you understand? Yes, guys. But however, what if I copy the same thing as it is, okay, and make one small change? Let's say, what if the date of policy was 1st April 2023? Then what would you do? What if the date of policy was 1st April 2023? Same 3 years policy. Same premium 1 lakh. Then would you still divide it by 4? No. See, if the policy is taken in the beginning of the year, on the 1st of April, if the policy is taken, then 3 years would be what? 1st April 2023 to 31st March 2026. This would be your 3 years period, guys. And this would touch upon exactly 3 years. This would touch upon previous year 23-24, previous year 24-25, and previous year 25-26. Only 3 years. So in this case, you will divide 1 lakh by what? You will divide 1 lakh by 3. So per annum, how much will you allow? Per annum, 33,333 you will allow, which you will restrict to rupees 25,000 unless you have a person who is a senior citizen or a super senior citizen. You're getting it, guys. So generally, if the policy is taken for 3 years, you will divide it by 4 because it would have touched upon 1 extra year. But if the policy is taken in the beginning of the year, on the 1st of April, if the policy is taken, then 3 years means you will divide by 3 only. You understood why? Yes, I've given you the logic also. Now, but however, in the examination, there is one more method in which the examiner very often asks questions. He says, like, for example, what if the date of, he doesn't give the date of policy sometimes. He doesn't give the date of policy. He just says that the policy is for 3 years and the premium is 1 lakh. If he just says that the policy is for 3 years and the premium is 1 lakh, if he has not given you the date of the policy, then 3 years means you will divide it by 3 years only. Are you clear with this? Yes. So therefore 33,333, we will restrict this to 25,000 rupees unless we have a senior citizen or a super senior citizen. So this was your 3 examples with respect to lump sum premium. This lump sum premium is a very, very popular concept from the MCQs point of view. Okay, very often asked in the MCQs about lump sum premium. If they've given you the date of policy and if the policy is for 3 years, you divide by 1 extra year, 4 years. But if the policy is taken on the 1st of April, then 3 years means you will divide by 3 years only. And lastly, if they don't give you the date of policy, if they just tell you that the policy is for 3 years, then 3 years means you will divide it by 3 years. This is your entire learning with respect to section 80D. Tell me, do you all have perfect clarity on section 80D as of now? Yes, guys, one final revision of section 80D, and then I'll take you to the next section, which is section 80DD. So under section 80D, we said our assessee has to be an individual or HUF. Whatever payment is being made over here, it has to be in non-cash mode only. Except preventive health checkup, this can be paid in any mode, doesn't matter. Then we said that what are the payments that you can make under section 80D? You can either pay medical insurance premium, or you can contribute towards central government health scheme, or you can make payment towards preventive health checkup, or you can incur medical expenses. Preventive health checkup, family, parents category put together should not exceed 5,000. Similarly, for HUF, total preventive health checkup should not exceed 5,000. For preventive health checkup, we have an internal limit of 5,000. Then we learned that the limit for each category will be 25,000. But in the respective categories, if even one person happens to be a senior citizen or a super senior citizen, then for that category, the limit will increase to 50,000. Then we spoke about medical expenses, that when will we allow medical expenses under section 80D? We will allow only if the person covered in these categories happens to be a senior citizen or a super senior citizen in whose name there is no medical insurance policy. Now, for this person, whatever medical expenses we've incurred, that medical expenses will be allowed under section 80D. Then finally, we spoke about lump sum premium. Now, in case in case premium is paid for multiple years together, in case we have this, lump sum premium adjustment, then if the premium is paid for 3 years, we will split it across 4 years. You understood why. But however, if the policy is taken on the 1st of April, then 3 years means we will divide by 3 years only. And also, if they don't give you the date of policy, if they just tell you that the policy was taken for 3 years, then we'll simply divide by 3 years and keep going on. All right, so this was our entire learning with respect to section 80D. Now I'll take you to your next section under the 80D series, which is section 80DD. Now, 80DD is more of a theoretical section, very less to see when it comes to questions. It will be a very straightforward application, okay? But we have quite a lot of theory to understand under section 80DD. So let's try to understand this. This section was not very important until, quite some time. But however, 2 years back, there was an amendment to section 80DD, after which, according to me, this section has become slightly more important from the examination point of view. So therefore, listen to me carefully. Under section 80DD, who is your assessee? Who is your assessee over here? Even over here, we're talking about individual or HUF. We're talking about resident, individual or HUF. Assessee has to be a resident, individual or HUF for the purpose of section 80DD. Now, this assessee, whoever is the assessee, this assessee should have a dependent. Okay, this dependent has to be a relative. Assessee should have a dependent who happens to be a relative. Now, who is relative? It depends. If the assessee is an individual, then relative will include spouse, relative will include children, relative will include brothers or parents of the assessee, and will also include brothers and sisters of the assessee. Okay. If the assessee happens to be a HUF, then relative would of course be the members of the HUF. Okay. So under 80DD, assessee is a resident individual or HUF. This resident individual or HUF has a dependent relative. Relative will include these people, and this dependent relative happens to be disabled. This dependent relative happens to be disabled. So assessee has a dependent disabled relative. So the hint, very simple hint, is section 80DD, two letters over here, D and D, which stands for dependent disabled. So assessee has a dependent relative who is disabled. There's a disabled person who is relative of the assessee and dependent on the assessee. Now, don't you think for this person's maintenance, assessee will be incurring good number of expenses? Assessee will be incurring expenditure. What are the eligible payments over here? Assessee would be incurring medical expenditure for this dependent disabled, because this first of all, he's a disabled relative and he's dependent on the assessee. So all his medical expenses will be borne by the assessee. Then assessee would also be incurring expenses towards training and rehabilitation of this dependent disabled. Then assessee might also make payment towards LIC or any other insurer for the maintenance of this dependent disabled. I'll tell you what is this. See, payments towards LIC insurer for the maintenance of this dependent disabled, very, very interesting concept. This is basically a scheme, all right. Under this scheme, the thought process is something like this. The assessee is thinking that while I'm alive, I'm taking care of this disabled relative. But what happens to this disabled relative after my death? So therefore, what the assessee does is, the assessee goes to LIC or any other insurer and takes a specific scheme for the maintenance of this dependent relative. So how this scheme works is, while the assessee is alive during his lifetime, he'll keep saving money over here in the scheme. And once the assessee dies, either the assessee dies or he reaches 60 years of age, let's say, and he does not, and is unable to take care of this. See, once he reaches 60 years of age, he would have retired from his work. So he's not having regular source of income. So how will he take care of this dependent disabled relative? So the scheme works in such a way that either if the assessee dies, or if the assessee reaches 60 years of age and stops making payment to the scheme, then the scheme will start releasing money for the maintenance of the dependent disabled. Sort of you understood. You'll get a better clarity as I discuss this entire section with you. Under section 80DD, my assessee is a resident individual or resident HUF. This assessee has incurred medical expenses or training or rehabilitation expenses, or this assessee has made payment to LIC or insurer, any other insurer under a scheme for the maintenance of this dependent disabled. Now, the assessee has a dependent relative who is disabled. So, for this disabled relative, assessee would have incurred all these expenses. Now, we don't care how much expense assessee has actually incurred. We will give the assessee a flat deduction. Are you understanding? See, assessee would have definitely incurred some expense, but how much expense he has incurred, that does not matter to us. Irrespective of how much expense he has incurred, we will give him a flat deduction of 75,000. If the disability is at least 40%, we'll give flat deduction of 75,000. But however, if it happens to be severe disability means the disability is at least 80%. If the disability is at least 80%, then we will give a flat 1,25,000 deduction. Now, these percentages, how will we get to know? The assessee has to get a medical certificate certifying, a doctor has to certify that what is a degree of disability or what is a percentage of disability. Basically, what is the percentage of body movements that this person is unable to do. If he is 40% disabled, only then we can even call him as disabled. If the disability is less than 40%, we can't even call him as disabled. So if 40% of his body movements he is unable to do, then he becomes a disabled person and my assessee can enjoy a flat 75,000 deduction. If the dependent relative is 80% disabled, then you call it as severe disability. In severe disability, you give a flat 1,25,000 deduction. These deductions are flat deductions, which means it does not matter how much the assessee has actually incurred. Assessee should have incurred some amount, but how much has he actually incurred, that is irrelevant. We will not bother about actual expenditure. We'll straight away give a deduction of the 75,000 and 1,25,000 number as the case may be. But point to be noted, in ATDD, are we talking about a case where assessee himself is disabled? See, whether assessee himself is disabled or not does not matter. Who is disabled over here? Assessee's relative, assessee's dependent relative is disabled over here. Are you understanding? Assessee has a dependent relative who is disabled over here. Whether the assessee himself is disabled or not, that is not a matter of discussion over here. We are talking only about others, either assessee's spouse or his children or his parents or his brothers and sisters or the members of the HUF family. Any of them happen to be dependent on the assessee and they happen to be disabled. That is when Section 80DD comes into the picture. So assessee would have incurred some expense. Irrespective of how much he has incurred, we will give him a flat deduction of 75,000 or 1,25,000 as the case may be. Understanding, everybody? Now listen, but there is one small catch. There is another section, Section 80U. 80U gives a similar benefit. When the assessee himself is disabled, we give deduction under Section 80U. I'll repeat once again. When does Section 80U come into the picture? 80U comes into the picture when assessee himself is disabled. Okay. Now, if this dependent disabled relative, see, he will be filing his own ITR also. In his own ITR, he is going to be the assessee. Do you agree? Are you listening to what I'm saying? This dependent disabled relative will be filing his own ITR also. In that ITR, this person, he himself is going to be the assessee. So if he is claiming Section 80U deduction for his disability, for the same disability, can assessee claim 80DD? Are you understanding? Like, let's say assessee's spouse is disabled, okay? Assessee's spouse is filing ITR. In that ITR, spouse is going to be the assessee. And if the spouse is disabled, the spouse can claim Section 80U. 80U can be claimed if assessee himself is disabled. So when the spouse is filing ITR, in that ITR, spouse is assessee. So if assessee is disabled, 80U deduction spouse will claim for his disability. Then put this aside. Now listen, spouse is dependent on the assessee. So assessee will say, I have a dependent disabled relative. Assessee will claim 80DD. So are you noticing, for the same disability of the spouse, for the same disability, spouse is claiming 80U, assessee is claiming 80DD. Will that be fair? No. So that is why there is a condition that this dependent disabled relative should not have claimed 80U. For the same disability, the assessee cannot claim 80DD also and 80U also for the same disability. Either the disabled person should claim 80U or the assessee should claim 80DD. For the same disability, both the sections are not allowed. So the dependent disabled relative should not have claimed 80U. Only then you can even step into 80DD. Tell me, is this point also crystal clear? Yes, guys. Yes, so this is it about our entire discussion on the first part of Section 80DD. We have one more part to discuss over here. Now listen, for the last final part of Section 80DD, you first have to understand about this scheme properly. Let me explain to you about the scheme first. See, the whole thought process behind the scheme is that the assessee is thinking that while I'm alive, I'm taking care of this dependent disabled relative. This relative of mine is dependent on me and disabled, and I'm taking care. But what happens to this dependent disabled relative after my death? Or what happens to this dependent disabled relative once I retire and I don't have a regular steady flow of income? Then how will I be able to maintain this dependent disabled relative? That is the thought in the assessee's mind. So what the assessee does is, assessee goes to LIC or any other insurer and buys a scheme for the maintenance of this dependent disabled relative. How the scheme works is that till the assessee is alive, the assessee keeps making contributions to this scheme. When will this scheme release money for maintenance? See, either the assessee dies. Either when the assessee dies or when the assessee reaches at least 60 years of age and he stops making payment to the scheme either when the assessee dies or when the assessee reaches at least 60 years of age and stops making payment to the scheme, then the scheme releases money for the maintenance of the dependent disabled. Did you understand this? Yes, so as long as the assessee is alive, assessee will keep making contributions to the scheme. Once the assessee dies, or once the assessee reaches at least 60 years of age and stops making payment to the scheme, then the scheme will release money for the maintenance of the dependent disabled relative. Now listen. So when is the scheme supposed to release money? We're continuing with the scheme discussion. When is the scheme supposed to release money? The scheme is supposed to release money only upon the death of the assessee or only after the assessee reaches at least 60 years of age and stops making payment to the scheme, guys. Right? But what if the assessee has not died? Also, assessee has not reached 60 years of age and stopped making payment to the scheme. Neither of those two situations have arisen, guys. Neither out of these two situations exist. But still, the scheme has made payment for the maintenance of the dependent disabled relative. Then don't you think the scheme is violating Section 80DD? Because under Section 80DD, what kind of scheme are we talking about? We're talking only about that scheme which releases money either after the assessee dies or after the assessee reaches at least 60 years of age and stops making the payment. What if even before that, what if assessee has not died, he has not reached 60 years of age, and before that itself the scheme has started releasing money for the maintenance of the dependent disabled relative? Then in that case, there is a violation. If this situation arises, then whatever Section 80DD deduction was claimed by the assessee all these years, it is all going to be reversed, which means reversed as in it's going to be taxed now for the assessee. It will be deemed to be income of the assessee and it will be taxed for the assessee. Understanding, if the assessee has not died and also he has not reached 60 years and stopped making payment to the scheme, but before that itself, if the scheme starts releasing payments for the maintenance of the dependent disabled relative, then whatever 80D deduction assessee has claimed all these years, it will be reversed and it will be deemed to be the assessee's income and to be taxed in the assessee's hand. The 80D deduction will be reversed. Okay. Now, one more situation is possible. See, why is the assessee saving money into the scheme? Because assessee is thinking that what happens to the dependent disabled relative after my death? But what if the dependent disabled relative predeceases the assessee? Are you understanding what I'm talking about? What if the dependent disabled relative, what if he predeceases the assessee? So basically what I'm talking about is a situation where the assessee kept making contributions to the scheme, thinking after my death, the scheme will help the dependent disabled relative. But assessee has not died yet. Assessee has not died, but the dependent disabled relative is dead. So the dependent disabled relative has predeceased the assessee. Now, don't you think the scheme has become pointless now? Because the scheme was supposed to release money only after the assessee's death to the dependent disabled relative. But the dependent disabled relative itself does not exist anymore. So the scheme has become pointless. So what happens to all the money which has gotten accumulated in the scheme? The scheme will return the money to the assessee. So if the dependent disabled relative predeceases the assessee, then whatever amount was deposited in the scheme all these years will be returned by the scheme back to the assessee, and that sum will be taxable for the assessee. So whatever amount the assessee had deposited into the scheme all these years, whatever deposits were made into the scheme all these years, the scheme will return the money back to the assessee, and for the assessee, the sum received from the scheme is going to be taxable. Understanding. So this is it about Section 80DD. The last 2 points are little tricky. That's why I went a little slow. I'm hoping you've understood. I'll repeat once again. In this relating to the scheme, there are 2 points. First of all, what is a scheme? We go to the LIC or any other insurer and take a scheme for the maintenance of this dependent disabled relative. The scheme will release money either when the assessee dies or when the assessee reaches 60 years of age and stops making payment to the scheme. Then the scheme will release money for the maintenance of the dependent disabled relative. But what if even though assessee has not died, even though assessee has not reached 60 years of age, before that itself the scheme has released money for the maintenance of the dependent disabled relative, then in this case there is a violation, and whatever ATDT deduction assessee has claimed all these years, it will be fully reversed. Then after this we learned that in case my assessee, there's one more situation we learned, in case my assessee in case a dependent disabled relative predeceases the assessee, which means the dependent disabled relative has died. So the dependent disabled relative itself does not exist anymore. So the scheme is going to be pointless. But all these years, assessee kept contributing to the scheme. So a lot of money would have accumulated over here. The scheme will return all that money back to the assessee because the scheme has become pointless now because the dependent disabled relative itself does not exist anymore. So the scheme will return the money back to the assessee. If the scheme returns money back to the assessee, whatever money is being returned by the scheme to the assessee, this will now be taxable for the assessee. Okay, so this is it about our discussion with respect to section 80DD. So if you are noticing over here, we are getting proceeds from the scheme. We are receiving some proceeds from the scheme and that's being taxable for the assessee. So this becomes a taxable policy. This becomes a taxable insurance policy. Why taxable insurance policy? Because you're getting the money back from the scheme. So the scheme is returning money back to you. You're receiving proceeds from the scheme and it's taxable for you. So this becomes a taxable policy. All right, so this was your entire discussion with respect to section 80DD. Under 80DD, assessee is an individual or a HUF. Assessee has a dependent relative who is disabled. And this dependent disabled relative, in his ITR, he is not claiming section 80U. Then assessee would have incurred some expense. How much he has incurred doesn't matter. We'll give the assessee a flat deduction of 75,000. But if it's severe disability, we'll give the assessee flat deduction of 1,25,000. All right, this was section 80DD. So we've learned about section 80D and 80DD. Let's go to the final section under the 80D series, which is section 80DDB. Now, under section, this is a much simpler section. Under 80DDB also, the assessee has to be either a resident individual or a resident HUF. Assessee is a resident individual or a resident HUF. Now, over here, what is the eligible expenditure? Over here, what happens is either the assessee himself or his dependent relative, any of them is suffering from a disease. Now, which disease? We call this disease as a specified disease. It's specified where? It's specified in Rule 11DD. See, do not get confused. Section 80DD talks about dependent disabled relative. It talks about disability. So 80DD talks about disability, whereas 80DDB talks about disease. Are you understanding? There are two different things. Under 80DD, we're talking about dependent disabled. We're talking about a dependent who is suffering from a disability. We're talking about disability over here. And under 80DD, assessee himself is not disabled. Only his dependent relative is disabled. But 80DDB, first of all, we're talking about disease over here and not disability. And the disease, who is suffering from the disease? Either the assessee himself or his dependent relative is suffering from the disease. Which disease? Disease which is mentioned in Rule 11DD. Now, for the treatment of this specified disease, the assessee would be incurring some expenditure, guys. Medical treatment expenditure he would be incurring. This expenditure is what we are covering under 80DDB. Now, who is dependent relative over here? Same thing only. If assessee is individual, the dependent relative could be the assessee's spouse, the assessee's children, the assessee's parents, and the assessee's brothers and sisters. So the meaning of dependent relative is the same only in 80DD and in 80DDB. And if assessee happens to be HUF, then any member of the HUF. Okay. So under 80DDB, either the assessee or his dependent relative is suffering from a specified disease. Specified disease mentioned where? Specified disease mentioned in Rule 11DD. Who is suffering from the disease? Either the assessee or his dependent relative is suffering from this disease. And for the treatment of this disease, assessee would have incurred medical expenditure. That is what we're covering under section 80DD, under 80DDB. So under 80DDB, what is the deduction that we are going to get? See, under 80DD, it was a flat deduction, which means how much did you actually incur? That was irrelevant for me. I straight away gave you 75,000 or 1,25,000, straight away gave you this much deduction. But under 80DDB, it's not a flat deduction. How much have you actually incurred? That matters. So under 80DDB, we will see what is the actual expenditure incurred on medical treatment, what is the actual expenditure incurred. We'll compare this with the maximum limit of 40,000 rupees. So the actual expenditure incurred of 40,000 rupees, whichever is lesser, that will be deduction under section 80DDB. However, this 40,000 limit will increase to 1 lakh rupees if the patient who is suffering from the disease happens to be senior citizen. So this 40,000 rupees will increase to 1 lakh rupees if the patient who is suffering from the disease, if the patient happens to be a senior citizen or a super senior citizen. Point to be noted, I am not saying that assessee has to be senior citizen or super senior citizen. I am saying whoever is suffering from the disease, if that person happens to be senior citizen or super senior citizen, then the limit will increase to 1 lakh rupees. So whatever is the actual expenditure incurred for medical treatment or 40,000, whichever is lesser, that's going to be a deduction under section 80DDB. But however, if the patient who is suffering from the disease happens to be a senior citizen or a super senior citizen, then we will increase the limit to 1 lakh. So by doing this, we'll find a number, guys. We'll get a number whichever is lesser. That number is going to be our 80DDB deduction. Now from this 80DDB deduction, we will subtract one thing. See, don't you think there is a possibility that we might be having a medical insurance policy in the name of this person suffering from the disease? So from the medical insurance company, we may have received some medical insurance compensation. So in case we have received any medical insurance compensation, if we have received from the medical insurance company, that has to be subtracted. Sometimes we may receive any amount from the employer. So all of that will be subtracted and only the balance is going to be your section 80DDB deduction. This is it about 80DDB. So over here, who's your assessee? Resident individual or HUF, either the assessee himself or his dependent relative is suffering from a specified disease mentioned in Rule 11DD. Now, for the treatment of the specified disease, assessee has incurred expenditure. That expenditure or 40,000, whichever is lesser, will be allowed under 80DDB. But however, if the patient happens to be a senior citizen or super senior citizen, then the limit will be 1 lakh rupees. So with this, you will get to know how much is the 80DDB deduction. From this, we'll subtract the medical insurance compensation receipt and any amount received from the employer. And the balance is what you can actually enjoy under section 80DDB. Okay, so now to get a little better clarity, let's try to compare two sections. Let's try to compare section 80DD and 80DDB. See, of course, they're not going to ask you to do these comparisons in the examination, but just that if you've done these comparisons beforehand, then in the examination, you won't get mixed up, you won't get confused between these two sections. So see, point number 1, 80DD is for is in cases where there is disability. 80DD is targeting disability. 80DDB is targeting specified disease. Okay. Then the second difference is that in 80DD, we are not covering cases where assessee himself is disabled. We are covering cases only when assessee has a dependent relative who is disabled. But in 80DDB, either the assessee or his dependent relative, any of them could be suffering from the disease. Even assessee is covered under 80DDB. And the third difference is under 80DD, we talk about a flat deduction. Basically, over here, the actual expenditure incurred is irrelevant. But under 80DDB, the actual expenditure that you have incurred is relevant. You don't get a flat deduction under 80DDB. Your actual expenditure is relevant over here. In 80DD, your deduction numbers are either 75,000 or 1,25,000 if severe disability. In 80DDB, the numbers are generally 40,000. But if the patient happens to be a senior citizen or a super senior citizen, then 1 lakh rupees. So these are your 4 main points of difference between 80DD and 80DDB. Perfect clarity. Yes, so with this, we have completed all our three ATD sections, ATD, ATDD, and ATDD. So coming to the ATE series now, under the ATE series, you will be learning section ATE, section ATEE, you will be learning about ATEA and ATEB. So totally, you have only 4 sections under the ATE series, ATE, ATEE, ATEA, and ATEEB. In all these 4 sections, the common point is that in all these 4 sections, it is interest paid which is allowed as a deduction. It is interest which is allowed as a deduction. In all these 4 sections, if you see, the common point is we allow the interest as a deduction. Okay, just a moment. I was telling you that under the ATE series, the common point is that what do we allow under the ATE series? It is interest that we allow under ATE series, interest on different kinds of loan. Like let's take up the first section, section ATE. Very simple section, guys. Under ATE, my assessee has to be an individual only. Okay. And this individual has taken a loan. What kind of a loan is taken? He has taken an education loan. Okay. Now, condition number 1, he has taken an education loan. Condition number 2, what kind of education? See, we are talking over here about higher education. When I talk about higher education, I'm talking about after your 12th grade. So education which is after passing the senior secondary exam, that is after your 12th grade. In other words, your college education, university education, your post-graduation, we're talking about that. We're not talking about school education over here. We're talking about education after the senior secondary exam. That is, we're talking about after the 12th grade, education after the 12th grade. Now, this education can be in India or it can be outside India, doesn't matter. Now, can you try to recall and tell me where in chapter 6A we were very particular that education has to be only in India? Where were we very particular about that? Tuition fees, very good. Remember tuition fee section ATC? There we said that the education has to be only in India. But over here, when it comes to section ATE, the education may be either in India or it may be outside India, doesn't matter. So assessee is an individual and we're talking about an education loan for study in India or abroad. The education is after passing the senior secondary examination. And who is getting educated, guys? Who is a student over here? Who is a student who is getting educated? Either the assessee himself, okay, or his spouse, okay, or his children, either assessee or his spouse or his children, or any other student for whom the assessee happens to be a legal guardian. Any other student for whom the assessee happens to be a legal guardian. So condition number 1, the assessee should have taken an education loan. The education should be after senior secondary examination in India or outside India. Condition number 3, who is getting educated? Either the assessee himself or his spouse or his children or any other student for whom the assessee is a legal guardian. Condition number 4, who is the lender? The lender over here should either be a bank or a financial institution, or the lender can also be an approved charitable institution. The lender can be any of these 4 people. So, and condition number 5, on this loan, we should be paying interest. See, I have 4 conditions. If all these 4 conditions are fulfilled, then on this loan, whatever interest I am making payment, this interest, I have to make the payment. So only on payment basis, this interest on payment basis will be allowed as a deduction under section ATE. Understood? So under section ATE, we are talking majorly about interest on education loan. So we'll have to see when did my assessee start making the payment of interest. Once the assessee starts making the payment of interest, only for 8 assessment years only, we will allow deduction under section ATE. Like for example, if the assessee borrowed the loan, let's say 5 years back, but assessee started making payment of interest only in the current year, then current year plus 7 more years. So total for 8 years only, we will allow deduction under ATE. Now in these 8 years, whatever interest my assessee pays, assessee will get a deduction. Understanding? I'll repeat once again. Let's say the date of borrowing was 1st of April 2013. And the assessee started making the payment. The first interest payment was made, let us say, only in 2023. in 23-24. So the first time interest payment was made was in 23-24. So 23-24, this was the first time when interest was paid. So 23-24 plus 7 more years, total 8 years. Only for these 8 years only, you will get a deduction under section 80E. So in these 8 years, whatever interest I've paid on this loan, I'll get as a deduction. Please keep in mind, I will get a deduction under section 80E only and only on payment basis. This is a special point about 80E. So 80E, we're talking about interest on education loan. Crystal clear, guys? Simple section. Assessee is an individual. Assessee has borrowed an education loan from a bank or from a financial institution or from any approved charitable institution. This assessee is taken an education loan for education after the senior secondary exam in India or outside India. Either the assessee himself is getting educated, or his spouse or his children or any other person for whom the assessee is legal guardian. Now, on this education loan, whatever interest assessee is making payment, that interest will be allowed as a deduction. That interest will be allowed as a deduction across how many years? It will be allowed as a deduction across 8 assessment years. So, assessee actually has to make payment. So, once the assessee starts making the payment, from that year plus 7 more years, total 8 years only. In these 8 years, whatever interest assessee has paid, I will allow that as a deduction under section 80E. Keep in mind, only on payment basis. Okay. This was your very first section in the 80E series. You've understood about 80E. Now let's come to the second section under the 80E series, which is section 80EE. 80EE. Now over here also, as who is the assessee? Same like 80E, even over here the assessee happens to be an individual. Now what are the conditions under 80EE? The first condition is that this assessee should have borrowed a housing loan. See, 80E was for education loan, right? 80EE is for housing loan. See, why are you borrowing a housing loan? Generally, you borrow a housing loan for two purposes. Either if you want to purchase a house or you want to construct a house. But here I'm not talking about construction. Here I'm talking only about purchase of house. You're borrowing a loan because you want to purchase a house, that too a residential house. We're not talking about a commercial property. We're talking only about a residential property. We're not talking about construction of property. We're talking only about purchase. See, this is a very, very unique point about 80EE. The thing is, understand, in the whole of Income Tax Act, purchase and construction, they generally go hand in hand. Whenever you talk about purchase, you also talk about construction. That is how it is generally everywhere in Income Tax Act. Only in 80EE and your next section 80EA, only in these two sections, there's a very special point. We're talking about purchase of house property. We are not talking about construction of house property. Are you understanding? In these two sections, we have a very unique point. We're talking only about purchase of house property and not construction of house property. Otherwise, if you see everywhere in your Income Tax Act, purchase and construction go hand in hand. Wherever you talk about purchase of property, you also talk about construction of property. Are you understanding? Only in 80EE, only over here, you are going to consider only purchase of property and not construction of property. So condition number 1, assessee should have borrowed a housing loan. A housing loan by to purchase what? To purchase a residential house property. And this residential house property, whether it is assessed to tax under IFHP or not, doesn't matter. Like for example, in capital gains, when you talk about section 54F, here you say that the residential house property has to be assessed to tax under IFHP. Yes, guys. Then under section 80C, when we spoke about the principal repayment, remember, even under section 80C, when we spoke about the principal repayment, we said that the residential property has to be assessed to tax under IFHP. But we don't have any such condition over here, whether this residential property is assessed to tax under IFHP or whether it is not assessed to tax under IFHP, it doesn't matter. Like for example, if the property is, let's say, not ready yet, okay, you will not have IFHP, because you will have IFHP only if the house is ready for occupation. Only then you will start doing IFHP calculation. So even if the property is not ready for occupation yet, you can still claim 80EE deduction. Understanding? So 80EE deduction is a very flexible deduction. Whether you are having IFHP or not doesn't matter. Whether this house property is assessed under IFHP or not doesn't matter. Like if the house is not ready, it will not be assessed under IFHP. It's okay. You can still claim 80EE deduction. So whether it is assessed to tax under IFHP or not, that is irrelevant. Then comes your third condition. Condition number 3, you borrowed a housing loan. Who is the lender? From whom did you borrow this housing loan? You should have borrowed this housing loan either from a bank or from a housing finance company. Condition number 4, what is the date of sanction? When was this loan sanctioned? What is the date of sanction? The loan should have been sanctioned in the previous year 16-17. Only in previous year 16-17 only this loan should have been sanctioned. Point to be noted, am I talking about the date of borrowing? No, I am not talking about the date of borrowing. I am talking about the date of sanction over here. See, where do we talk about the date of borrowing? In IFHB chapter, date of borrowing has to be on or after 1st April 1999. There we talk about the date of borrowing. But over here in 80EE and all, we'll talk about the date of sanction of the loan. Date of sanction of the loan, when was the loan approved? The loan should have been sanctioned on during the previous year, 16-17. Okay. Then comes my fifth condition. What is the amount of the loan? How much loan has been sanctioned? Condition number 5. What is the amount of loan sanctioned? What is the amount of the loan? The loan amount has to be less than or equal to rupees 35 lakhs. The loan amount should not be more than 35 lakhs. How much loan is sanctioned, guys? Maximum only 35 lakh loan we are talking about. Condition number 6, how much is the assessee going to pay for the property? What is the value of the residential house property? When I talk about the value of residential house property, I'm talking about the consideration. For how much is the assessee going to buy this residential house property? Not for more than 50 lakhs. It has to be within 50 lakhs. Understanding? So condition 1, it should be a housing loan. Condition 2, why did you borrow this housing loan? For purchase of a residential house property, whether assessed to tax under IFHB or not doesn't matter. Then, who is the lender? The lender has to be a bank or a housing finance company. The loan should be sanctioned in the previous year 16-17. The loan should be within 35 lakh rupees and the value of the property should not be more than 50 lakh rupees. One more point, on the date of sanction of the loan, whenever the loan is getting sanctioned, on that day, the assessee should not own any residential house property. On the date on which the loan is sanctioned, on that day, my assessee should not own any residential house property. Understanding? The date on which the loan is sanctioned, on that day, the assessee should not own any residential house property. We have all these 6 conditions. If all these conditions are fulfilled, then we will see how much interest has been incurred by the assessee. This interest on this housing loan, not on payment basis, guys. Here I'm covering on accrual basis. So whether the interest is paid or not doesn't matter. This interest on accrual basis will be allowed under section 80EE. We will allow this interest on accrual basis under section 80EE. Whether the interest has been paid or not paid doesn't matter. On accrual basis, this interest will be allowed. This was section 80EE. So we've learned 80E and 80EE. I'm hoping you've noticed that in 80E, I allow the deduction of interest on payment basis, whereas in 80EE, I allow the payment of interest on accrual basis. So whether you've made the payment or not, it doesn't matter. On accrual basis, whatever interest you've incurred, I will allow that interest under 80EE. Please remember the points. The main points being the loan should have been sanctioned during 16-17 only. Current year, whatever interest you have incurred on accrual basis, it will be allowed. The lender can be bank or housing finance company. Loan should be a housing loan for purchase of a residential house property and not for construction. Loan should not exceed 35 lakhs. The value of the house should not exceed 50 lakhs. This was section 80EE. Now coming to section 80EA. Now under 80EA also, the section is very similar to section 80EE. So what I'll do is, by the way, I missed one small point. In 80EE, the maximum deduction which you can get in 80EE is rupees 50,000. This is a maximum deduction which you can enjoy under section 80EE. You don't have any such maximum limit in section 80E. In section 80E, whatever interest you've paid, whatever is the amount, fully allowed. 80EE, you have a maximum limit of 50,000. Okay. Now listen, I am copying the whole of 80EE as it is, okay? And there's going to be one small change between 80EE and 80EA. I'll show you that. Listen. I've copied the same section. You can see exactly where the differences are. We're talking about the third section under the 80E series, which is section 80EA. Even over here, assessee has to be an individual. Even over here, the assessee has borrowed a housing loan. Even over here, the loan should be borrowed only for purchase of a residential house property and not construction. The property may be assessed to tax under IFHB or not, doesn't matter. Even over here, the lender may be a bank or a housing finance company, but here the date of sanction changes. Here, the date of sanction can be across 3 previous years. The date of sanction may either be in previous year 1920, or it may be in previous year 2021, or it may be in previous year 21-22. So when was the loan sanctioned? The loan could have been sanctioned in any of these 3 previous years, either in previous year 1920 or 2021 or 21-22. In 80EE, we said that the loan should be sanctioned only in previous year 16-17. In 80EA, we're talking about 1920, 2021 and 21-22. Even in 80EA, when on the date on which the loan is sanctioned, on that day, your assessee should not own any other residential house property. Then here, there is no limit on the amount of the loan. The amount of the loan can be anything. There is no limit at all. Like in 80EE, we had 35 lakhs limit, right? In 80EEA, we have no limit. The loan can be of any amount, but however, there is a limit on the value of the residential house property. But here we're not talking about the consideration. It doesn't matter how much consideration we are paying. Here we are more bothered about the STV. What is the STV of this house? The STV of the house has to be within 45 lakhs. Okay. In section 80EE, the consideration that we are paying for the house should be within 50 lakhs. In 80EA, the stamp duty value of the house has to be within 45 lakhs. So these are the conditions. If all these conditions are fulfilled, whatever interest you have incurred on accrual basis, again, whatever interest you have incurred, that interest will be allowed under 80EA, but the maximum here is going to be 1,50,000 and not 50,000. See, this is housing loan interest. Don't you think housing loan interest I would have also enjoyed as a deduction under section 24 in your IFHP chapter? Yes, interest on housing loan, right? We're covering over here. Interest on housing loan is also covered under IFHP chapter. But if you're already claiming in IFHP chapter, then of course you can't claim here again. If you're not claiming in IFHP chapter, then you can claim over here. Like for example, under section 24, for self-occupied property, you have a limit of 2,30,000, right? Two limits you have. Now, what if your interest is 2,20,000? 2 lakhs only you can claim under IFHP. Balance 20,000 you can claim over here. So the interest which you're not claiming in IFHP, the balance interest on housing loan, you can claim under 80EE and 80EA. So you've learned 3 sections under the 80E series. 80E, which is for interest on education loan. 80EE, which is interest on housing loan. And 80EA, which is interest on, again, housing loan. All right. So 80EE and EA are very similar. But what are all the differences that we have seen, guys? The first difference, if you see, was the date of sanction. This was the first difference. The second difference is loan. There is no limit on the amount of loan. Third difference, STV of the property has to be within 45 lakhs. And the fourth difference, maximum 1,50,000. Totally 4 differences. First difference is about the date of sanction. Second difference is about the value of the loan. Third difference is about the STV. And the fourth difference is about the maximum limit. These are your 4 differences between 80EE and 80EA. Now, coming to the final section under the 80E series, we have section 80EEB. Now, 80EEB is a slightly different section. Even here, we're talking about interest only. Even over here, who is the assessee? Even over here, the assessee is an individual. But here, what kind of a loan has he borrowed? Here, he has borrowed a loan because he wants to purchase an electric vehicle. In 80E, my assessee had borrowed an education loan. In 80EE and EA, assessee had borrowed a housing loan. In 80EEB, assessee is borrowing a loan because he wants to purchase an electric vehicle. We're talking about electric vehicle loan. Okay, condition number 1. Condition number 2, when was the loan sanctioned? What is the date of sanction of the loan? Here we have 4 previous years, guys. The loan should have been sanctioned either in previous year 1920 or in previous year 2021 or in previous year 21-22 or in previous year 22-23. A loan should be sanctioned in any of these 4 years. There is no limit on the amount of the loan. Who is the lender? From whom did you borrow the loan? You borrowed the loan either from a bank or you borrowed the loan from NBFC. That's all. Only 3 conditions. If all these 3 conditions are fulfilled, then whatever interest has accrued, even over here on accrual basis, I will allow whatever interest has accrued on accrual basis, this will be allowed under section 80EEB. So even over here, we're talking about accrual basis. So if you see, except ATE, all the other sections we talk about accrual basis only. And what is the maximum deduction you will get over here? 1,50,000, same like section 80EEA. Okay, this is 80EEB. In 80EEB, we're talking about loan which my assessee has borrowed because he wants to purchase an electric vehicle. Okay, the loan should be sanctioned in previous year 1920 or 2021 or 2122 or 2223. The lender should be a bank or an NBFC. Whatever interest has accrued on accrual basis, whether the payment has happened or not doesn't matter. Whatever interest has accrued, it will be allowed up to a maximum of 1,50,000. So these are your 4 sections on 80 E series. Okay. Now, if we have to compare the 4 sections, we have section 80E, we have section 80EE, then we spoke about section 80EEA, and finally we spoke about 80EEB, guys. We have totally 4 sections we're talking about. Let's try to compare these 4 sections. First of all, what kind of loan are we talking about? 80E, it is education loan. 80EE, it is a housing loan. Even 80EA, housing loan. And these 2 housing loans are not for construction of property, but only for purchase of property. What kind of property? Residential property. Whether it is assessed to tax under IFHB or not doesn't matter. And 80EEB is a loan which you've borrowed because you want to buy an electric vehicle. Then condition number 2, who is the lender? In 80E, the lender can be a bank, or the lender can be a financial institution, or the lender can also be an approved charitable institution. 80EE, the lender has to be a bank, or the lender has to be housing finance company. Even 80EEA, the lender has to be a bank or a housing finance company. 80EEB, however, the lender has to be a bank or NBFC. NBFC, like non-banking finance companies, like your Muthoot Finance. Basically, they are not banks, but they give loans. You have Bajaj Finance, Muthoot Finance, non-banking finance companies. Then condition number 3, what is a maximum limit? 80E, there is no maximum limit. 80EE, maximum 50,000 limit. 80EA, maximum 1,50,000 limit. 80EB, also 1,50,000 limit. Then on what basis do we allow the deduction? 80E, we allow the deduction only on payment basis, but 80EE, we allow the deduction on accrual basis. Even 80EA, we allow on accrual basis, and even 80EEB, we allow on accrual basis. Alright, so this was our entire learning with respect to the 4 sections under the 80E series. Apart from this, we have extra points, like for example, under 80E, we had learned that the loan should be for higher education after school, like and the education can be in India or outside India. Who is getting educated? Either the assessee himself, or his spouse, or his children, or any other student for whom the assessee is the legal guardian. And we had also spoken under 80E, a deduction is allowed only for 8 years. Once you start paying the interest from that year, total for 8 years only, I will allow 80E deduction. 80EE, we had learned extra points. The loan should not be more than 35 lakhs, and the value of the house, the consideration for the house should not be more than 50 lakhs. And on the date on which the loan is sanctioned, on that day, you should not have owned any other property. See, one more point we can add over here. When was the loan sanctioned? No such period in 80E. For 80EE, we're talking only about previous year 16-17. 80EA, we're talking about previous year 1920, 2021, and 21-22. And 80EEB, we're talking about previous year 1920, 2021, 21-22, and 22-23. Okay, so with this, I think you have solid understanding about all these 4 sections under the 80E series. So we've learned the 80C series, 80D series, and the 80E series. Perfect understanding. All right. So with this, we are done learning with the 80C series, 80D series, 80E series. Now we'll start off the next series, which is 80G series, the next set of sections. In the 80G series, you will be seeing 80G, 80GG, 80GGA, and 80GGB, and finally 80GGC. So totally, you have 5 sections under your 80G series. Let's discuss them one by one. Let's take up the sections. The first section we'll take up is section 80G. Now, 80G is with respect to donations. Like, for example, if I'm going to make a donation to any charitable institution, I'll get a deduction under section 80G. Okay, now let us discuss this. See, if you notice, all the sections that we've seen so far, who was your assessee? Either your assessee was individual or your assessee was individual HUF. Do you agree? All the sections, if you see, any of the sections, if you see that we've discussed, who was the assessee? Either the assessee was individual or the assessee was individual or HUF, which means companies, firms, LLPs and all. We did not even talk about any of these assessees. But however, under section 80G, point number 1, the assessee can be any assessee. So the assessee can even be a company. Assessee can even be an LLP. Assessee can be an individual, firm, HUF, company, AOP, BOI, any person. Assessee can be any person. Okay. Now, under 80G, there's a small catch. Do you remember there was one section which we had spoken about where we said that the mode of payment has to be non-cash mode only? Do you remember which section was that? Only one section we've seen till now which spoke about the mode of payment. That was section 80D, guys. 80D, irrespective of the amount, you have to make the payment in non-cash mode. However, in 80G, it's slightly different. In 80G, first of all, the donations. See, 80G is about donations, right? So in 80G, first of all, donations have to be in money only, and donations cannot be in kind. Like if you're going to go, if let's say you go to an orphanage and you donate, let's say 10 kgs of rice, you're not going to get 80G deduction. 80G deduction you will get only and only if the donation is in kind. Only the donation is in money. The donation should not be in kind. The donation should not be in kind. Donation has to be in money. And when you're donating in money, in what mode should you donate? It depends upon how much are you donating. If you're donating up to 2000, you can donate in any mode, doesn't matter. But however, if you are donating more than 2000 rupees, the donation has to be only in non-cash mode. See, this is slightly different from what you've learned under 80D. In 80D, there was no limit. Do you recall? In 80D, there was no limit. Irrespective of how much you're making payment, you have to make the payment in non-cash mode. But in 80G, you have the 2000 limit. Only if you're donating more than 2000, only then I'm talking about the mode of payment. Okay. So under 80G, my assessee can be any assessee. The assessee is making a donation. If the donation has to be in money form, the donation should not be in kind. And when the donation is in money form, up to 2000, it can be in any mode. More than 2000 has to be only in non-cash mode. Now listen, under section 80G, you have totally 4 categories of donations. Okay, in the category A, you have those donations wherein you will get 100% reduction. All right. In category B, you have those donations where you will get only 50% reduction. Category C, you have those donations where you will get 100% deduction, but subject to a qualifying limit. And in category D, you will get 50% deduction, but again subject to a qualifying limit. Okay, so under 80G, we have 4 categories of donations, category A, B, C, and D. In category A, you get 100% deduction. Category B, you will get 50% deduction. Category C, 100% but subject to one qualifying limit. And category D, 50% again subject to one qualifying limit. Now let's go a little deeper. See, in category A, what are the deductions, what are the donations which you have in category A? Like, for example, if you're going to make a contribution, I tell you the important ones. If you make a contribution to Prime Minister National Relief Fund, Prime Minister National Relief Fund, or if you make a donation to PM Cares Fund, you must have heard about PM Cares Fund quite a lot during the COVID times. So Prime Minister National Relief Fund, PM Cares Fund, or if you make a donation to, there's an Africa Fund also. If you make a donation to the Africa Fund, see all these Prime Minister funds and national funds you will find over here. Then there's also a National Foundation for Communal Harmony, National Foundation for Communal Harmony, or if you make a contribution to any university or any educational institution which is of national eminence, any university or educational institute which is of national eminence, or if the contribution is being made to the Zilla Sakshart Samiti, all these national funds and Prime Minister funds are what we're talking about over here. Then we have an Andhra Pradesh fund over here. Then we have this National Sports Fund also under ATG category A. Then we have the National Children's Fund. We have the Swachh Bharat Kosh. The Swachh Bharat Kosh. Then we have the Clean Ganga Fund. Then we also have over here the National Fund for Control of Drug Abuse. National Fund for Control of Drug Abuse. All of these funds come under category A, wherein under category A you will get 100% deduction. So whatever you contribute, full amount you will get as a deduction. So what's a hint? See, of course, you don't have to sit and memorize this list. You just have to familiarize yourself with the list. You have all these Prime Minister funds and national funds over here. All right, I'll repeat once again, one by one, I'll repeat once again. First of all, you have the Prime Minister National Relief Fund. First one is Prime Minister National Relief Fund. Then you have Prime Minister Cares Fund, PM Cares Fund. The full form is Prime Minister Citizens Assistance and Relief in Emergency Situations Fund. PM Cares Fund, the full form is Prime Minister Citizen Assistance and Relief in Emergency Situations Fund. This is your PM Cares Fund. Then you have an Africa Fund. Then you have National Foundation for Communal Harmony. NFCH stands for National Foundation for Communal Harmony. Then you have contributions to any university or any educational institute which is of national eminence. Then you have a Gujarat Earthquake Fund. You have another Maharashtra Fund, an Andhra Pradesh Fund. Then you have Zilla Sakshart Samiti, National Sports Fund, NSF National Sports Fund. Then NCF is National Children's Fund. NCF National Children's Fund. Just know that National Children's Fund was earlier under category B. Okay, but now it's under category A, National Children's Fund. Then we have Swachh Bharat Kosh, we have Clean Ganga Fund, we have National Fund for Control of Drug Abuse. So all of these come under category A, 100% deduction. Whatever you contribute, full deduction you will get under category A. Then you have category B. Under category B, you have, earlier we had 4 points under category B. Okay. But now there's an amendment by Finance Act 2023. Let me tell you the old and the new provision. As per the old provision, we have 4 adjustments or 4 donations over here. The first one was, there was a Jawaharlal Nehru Memorial Fund. Then we had the Indira Gandhi Memorial Trust. Then we had the Rajiv Gandhi Foundation, and we had a Prime Minister Drought Relief Fund. So we had totally 4 donations over here. Here we had the Nehru family, Jawaharlal Nehru, his daughter Indira Gandhi, her son Rajiv Gandhi. So this is how we used to, take this as a hint, and this is how we used to learn this. So category B, we had these 4 adjustments. But if you look at Finance Act 2023, these 3 funds, the first 3 funds from the Nehru family have been removed, and we only have Prime Minister Drought Relief Fund left over here. Okay, so under category B, for your examination, for May 2024 examination onwards, under category B, we are left with only one donation now, which is Prime Minister Drought Relief Fund. So today, if you make a donation to the Jawaharlal Nehru Memorial Trust or to the Indira Gandhi Memorial Trust or to Rajiv Gandhi Foundation, today if you make a donation to any of these, you're not going to get any deduction under section 80G at all. Okay, then comes category C. In category C, whatever donations you make, you get 100% deduction, but subject to a qualifying limit. What is a qualifying limit? We'll see later. Over here, number 1, if you are going to make any donation to any institution for promotion of family planning, any donation which you make to any institution for promotion of family planning. I'll repeat one last time. Donation made to any institution for promotion of family planning will fit under category C. Also, if you make any donation to the Indian Olympic Association, any donation to Indian Olympic Association or any other sports association, because towards development of sports infrastructure in our country. So 100% deduction subject to qualifying limit. Here, if you see, from your examination point of view, if you see, only the first point is important. This is the one that we generally see in the examination, promotion of family planning. But just know that there is one more, donations to Indian Olympic Associations or any other sports association for improvement of sports infrastructure in our country. Even that fits under category C. Then comes category D. In category D, you're making donation to any charitable institution. You're making donation to any approved charitable institution. Like any charitable institution, you make a donation, a charitable institution which should have ATG certificate. Basically, an approved charitable institution. You should be making donation to an approved charitable institution, or you can also make donation to any notified temple or to any notified church or any notified gurudwara, any religious institution, or any other historic institution, or any institution of archaeological importance or artistic importance, either for renovation or for repair. So in the last point, I'll repeat the last point once again. In the last point, you're making donation to any notified temple, mosque, gurudwara, or any other place of historic importance or archaeological importance or artistic importance. Why are you making the donation? For renovation or repair. Here you will get a deduction, a 50% deduction subject to qualifying limit. All right. So you have totally 4 categories of donations under ATG. Under section ATG, point number 1, assessee can be any assessee. Point number 1, the assessee can be any assessee. But however, you should remember that this assessee has to make the payment only and only in money form. The donation cannot be in kind. The donation has to be only in money form. And how much, what's the mode of payment? If the payment is up to 2000, the payment can be in any form. But if the payment is more than 2000, then it has to be only and only in non-cash mode. Okay. Then we learned that under this ATG, we have totally 4 categories of donations. Category A, where you get 100% reduction. Category B, where you'll get 50% reduction. Category C, where you'll get 100% deduction but subject to qualifying limit. And category D, which is 50% reduction, again subject to qualifying limit. Okay. Now under category A, we have all these Prime Minister funds and national funds. Under category B, we have the Prime Minister Drought Relief Fund. Under category C, we have donations towards promotion of family planning and donations to Indian Olympic Associations. Please know that donation to Indian Olympic Association can be made only by companies. Okay. Indian Olympic Association is only for company assessees. And category D, we are making a contribution to approved charitable institution or any notified temple, church, or any other institution of archaeological importance or historic importance or artistic importance for renovation or repair. So these are your donations which are covered under section ATG. Now, what do we have to understand? See, we spoke about some qualifying limit. What is this qualifying limit? For category C and for category D, we need the qualifying limit. Now, what is a qualifying limit? Let's focus on that. Listen to me. Our next discussion, what is qualifying limit? See, first of all, we have to find adjusted total income. Now, what is adjusted total income? You'll have to take your GTI, okay? From the GTI, subtract section 111A STCG. Also subtract all LTCG. See, I'm not asking you to subtract all special rate incomes. I'm asking you to subtract only 2 special rate incomes, which is LTCG and 111A STCG. Also subtract all chapter 6A deductions, except section ATG, except this section, except section ATG, subtract all chapter 6A deductions. What you get finally, this will be your adjusted total income. Okay, now this number, 10% of this number, 10% of adjusted total income is going to be your qualifying limit. So what is your qualifying limit? Qualifying limit is nothing but 10% of adjusted total income. And what is adjusted total income? It's your GTI minus 111A STCG minus all LTCG and minus all chapter 60 deductions except section ATG. All right, 10% of that is going to be your qualifying limit. And we need the qualifying limit only for category C and for category D. This was a very quick discussion on section ATG. So under section ATG, points to be noted: assessee can be any assessee. Mode of payment more than 2000 has to be non-cash mode. We have 4 categories. For category C and D, we need qualifying limit. Qualifying limit is 10% of adjusted total income. All right, this was your very first section under the 80G series. This was section 80G. Now taking you to the next section under the 80G series, which is section 80G. Section 80G. Now listen to section 80GG. 80GG is a very specific section. Now see, if your assessee is having rent expense and if assessee is receiving HRA, listen carefully. If assessee is having rent expense and if assessee is receiving HRA from the employer, the assessee will enjoy a benefit, right? HRA exemption assessee will enjoy. You remember we'll calculate three things under the salaries head. Three things we'll calculate: 50% of salary or 40% of salary depending upon metro, non-metro. Then HRA actually received, and then rent paid minus 10% of salary. Whichever is least will be exempt. Received minus exempt balance will be taxable. So if your assessee is having rent expense and if your assessee is also receiving HRA from the employer, then the assessee gets a benefit in the form of HRA exemption. But what if the assessee is having rent expense and assessee is not getting HRA? Then I have to give him some benefit, because if assessee is having rent expense and if he is getting HRA, I am giving him HRA exemption. What if he has rent expense but no HRA? Then what benefit will I give him? That is where 80GG comes into the picture. Are we understanding? I'll repeat one final time. If my assessee has rent expense and is also receiving HRA, then I give my assessee a benefit in the form of HRA exemption. But however, what if my assessee has rent expense but is not receiving HRA? Then in that case, I will give the assessee 80GG benefit. Okay. Now under 80GG, there are some conditions. The first condition, the very first condition is that the assessee should not be getting HRA. That's the first condition. Only then you will fit into 80GG, guys. So either the assessee has to be an employee but is not receiving HRA, or the assessee has to be a self-employed person. Because if you're a self-employed person, nobody is giving you salary, nobody is giving you HRA. So either the assessee has to be an employee but is not receiving HRA, or the assessee is a self-employed person. Condition number 1. Condition number 2, this assessee must have a rent expense. Rent expense indicates what? This indicates that assessee is living in a rented house. Assessee is renting out a house. Assessee is taking a house on rent, and for that house, assessee is paying rent. So assessee must be having rent expense. This is my second condition. Assessee is having rent expense. Now comes the third condition. See, why is the assessee having rent expense? The third condition is that the assessee himself, neither the assessee himself, nor his spouse, nor his minor child, nor his HUF, none of them should own a house. None of them should own a house in the city in which he lives in. Why is he living in a rented house? Why is he having rent expense? Why? Because he does not own a house in the city in which he lives in. Like for example, let's say I'm living in Bangalore. In Bangalore, I myself, my spouse, my minor child, my HUF, none of us should own a house in Bangalore where I'm living in. Can I own a house in any other city? Yes, the assessee, if at all the assessee owns a house in some other city, that is fine. I can have a house in some other city, but this house should not be a self-occupied house. Understanding? This house should not be a self-occupied house. So I have totally 4 conditions. Condition number 1, the assessee must not be getting HRA. How come? Either the assessee is an employee but is not receiving HRA, or the assessee is a self-employed person and is not getting any HRA. Condition number 2, the assessee must be having rent expense. Why is the assessee having rent expense? Because in the city in which he is living in that city, neither he himself nor his parents nor his not parents, neither the assessee himself nor his spouse nor his minor child nor his HUF, none of these 4 should own a house in the city in which he is living in. Okay. And the last condition is that if at all the assessee is owning a house in some other place, it should not be a self-occupied house. It can be an unoccupied house. It can be a let-out house, but it cannot be a self-occupied house. I have 4 conditions. If all these 4 conditions are fulfilled, then my assessee will get section 80GG deduction. To compute 80GG deduction, we'll have to calculate totally 3 things. Out of the three things, we will pick whichever is the least of the three things, and that's going to be your 80GG deduction. What are the three things? Number one is going to be 5,000 rupees per month. Number two, 25% of your adjusted total income. And number three, actual rent minus 10% of adjusted total income. Actual rent minus 10% of adjusted total income. Now here, adjusted total income will have the same meaning, or I should say similar meaning, like what we saw in 80G also. What is adjusted total income? Something very similar. You'll have to see what's the GTI of the assessee. From that, remove 111A STCG. Also remove all LTCG. Okay. Also remove Chapter 6A. Remove all Chapter 6A except with section. Here, all Chapter 6A except section 80GG. The net number that you get, that will be your adjusted total income. This is section 80GG. That's all. See, remember, section 80G is with respect to donations. 80G is targeting donations. 80GG is targeting rent expense. So under 80GG, condition number one, assessee should not be having HRA. Either the assessee should be an employee but not having HRA, or the assessee should be a self-employed person, condition one. Condition 2, assessee must be having rent expense. Condition number 3, why is he having rent expense? The reason is, in the city in which he is living in that city, neither he himself, nor his spouse, nor his minor child, nor his HUF, none of them should own a house in the city in which he is living in. If at all the assessee owns a house in some other city, yes, in some other city he can own a house, but that house should not be a self-occupied house. We have 4 conditions. If all 4 conditions are fulfilled, then your assessee will be eligible for 80GG deduction. How will you compute 80GG deduction? You will calculate totally 3 things. Number 1, 5,000 per month. Number 2, 25% of adjusted total income. And number 3, actual rent minus 10% of adjusted total income. Tell me the 3 things one last time. 5,000 per month, then 25% of adjusted total income, and finally, actual rent minus 10% of adjusted total income. Out of these 3 numbers, you will pick whichever is the least number, and that's going to be your section 80GG deduction. 3 numbers you're calculating: 5,000 per month, 25% of adjusted total income, actual rent minus 10% of adjusted total income. Out of these 3, whichever is the least is going to be your 80GG deduction. What is adjusted total income? GTI minus 111A STCG minus all LTCG minus all Chapter 6A deductions except section 80GG. The balance will be your adjusted total income. Okay, here the most important part is your 4 conditions. See, 80GG is a section which is very simple as such. But the problem over here is, in the examination, it just doesn't strike us that we have to think about 80GG. Because the question paper is never going to, expressly tell you that think about 80GG. So identifying in the examination environment that 80GG is applicable, that is a task. So whenever you find in the question that assessee has paid rent, we're going to devise a hint for ourselves so that we don't make a mistake. So the hint is that whenever you see in the question paper that the assessee has paid rent for his house, immediately section 80GG should come to your mind. I'll repeat again. As soon as the question paper says that assessee has paid rent for his house, section 80GG should come to your mind. Okay, so this was section 80GG. Crystal clear? 2 sections we've learned under the 80G series. We have learned about 80G and we have learned about 80GG. Let's go to the next section now, which is section 80GGA. Now listen, in PGBP chapter, you had learned if the assessee is carrying on a business or a profession, and if the assessee makes a contribution to IIT or IIM or to the National Laboratory or to any approved research association or to any Indian scientific research company for the purpose of scientific research or research in social science or research in statistical science, then you give the assessee a deduction under section 35. Do you remember this? It is allowed, right? Under PGBP head, under your PGBP head, it is allowed. Under your PGBP head, it is allowed, right, guys? If your assessee is carrying on a business or profession, and if the assessee makes any contribution to outsiders for scientific research or research in social science or for statistical research, you give your assessee an allowance. It is allowed under the PGBP head. Similarly, if the assessee is having a business or a profession, and if the assessee is making a contribution to National Fund for Rural Development, or if assessee is making a contribution to National Urban Poverty Eradication Fund. Guys, do you remember these two funds? Very recently in the PGBP head, we had discussed about this. Do you recall? I had told you very clearly in the PGBP head that generally donations go to Section 80G, but donations to National Fund for Rural Development, donations to National Urban Poverty Eradication Fund don't go to 80G. Instead, under your PGBP head, it is allowed. I am hoping at least this is sounding very familiar to you. Yes, National Fund for Rural Development and National Urban Poverty Eradication Fund. So, if the assessee has business or profession, and if the assessee is making these contributions, we are allowing it under PGBP head. But what if the assessee does not have any business or profession? If the assessee does not have any business or profession, and if the assessee is making a contribution to outsiders for scientific research, social science, statistical research and all, or if assessee is making contributions to these funds, if assessee is not having any business or profession, then under the PGBP head, it will not be allowed, guys, because no business or profession, so no PGBP head. So in that case, under Section 80GGA, it will be allowed. You understood the whole purpose of 80GGA. If assessee is having business or profession, all these payments are allowed under PGBP itself. But if assessee does not have business or profession, then where will these contributions go? These contributions will come to Section 80GGA. Even in 80GGA, like Section 80G, even over here you have the same point that if you're making the payment up to 2000, you can make the payment in any mode whatsoever, doesn't matter. But if you're making payment of more than 2000, it has to be only and only in non-cash mode. That's all. This is it about Section 80GGA, a very simple section, a very logical section also, because if I have business or profession, then these payments will get me an allowance under the PGBP head. But however, what if I don't have business or profession? Then these contributions, I will get Section 80GGA. What are the payments, guys? Contributions to IIT, IIM, National Laboratory Research Association, or any approved institution, or any Indian scientific research company for a scientific research or research in social science or statistical research. And also contributions to National Fund for Rural Development and National Urban Poverty Eradication Funds. So these contributions, if assessee does not have a business or profession, these contributions will be allowed under 80GGA. There is no maximum limit. Whatever the assessee contributes, fully it will be allowed under 80GGA. Up to 2000, you can make the payment in any mode, but if you're making a payment of more than 2000, it has to be only and only in non-cash mode. All right, guys. Now, this is Indian Scientific Research Company. In case you're wondering, this is Indian Scientific Research Company. Basically, any company whose main objective is doing scientific research. All right. A company, an Indian company whose main objective is doing scientific research. So this was Section 80GGA. And finally, you have two sections, two interconnected sections, Section 80GGB and Section 80GGC. Let's discuss them together. Section 80GGB and Section 80GGC, I had already discussed these sections with you in the PGBP head, giving you a quick revision of these two sections one final time over here. 80GGB is applicable only and only for Indian companies. 80GGC is applicable to others. All right. Like if I'm an individual, I will fit under 80GGC. But if I'm a company, an Indian company, I will fit under 80GGB. So under 80GGB, I am either making a contribution to a political party or I am making a contribution to the electoral trust, or I'm giving an advertisement in a newspaper or in a brochure or in a souvenir which is published by a political party. All right. Now, any of these donations, if I make, or any of these contributions I make, I will get 80 GGB deduction. The only point is that irrespective of the amount, irrespective of how much amount I'm contributing, it has to be only in non-cash mode. There is no upper limit. How much ever I donate, how much ever I contribute, I will get as a deduction under section 80 GGB, 80 GGC. Okay. Now, what is 80 GGC? In 80 GGC, if you notice, I'm copying the exact same thing as it is, all right? And there's going to be one single change only. That change is that advertisement in newspapers and brochures and publications of political party is not covered in 80 GGC. This is the only catch. So under 80 GGB, we are applying this section only to Indian companies. 80 GGC, we are applying to others. In 80 GGB, I have 3 transactions: contributions to political parties, contribution to electoral trust, advertisements in newspapers, brochures, souvenirs of political parties. Irrespective of the amount, payment has to be made in non-cash mode. Under 80 GGC, we are covering only 2 transactions: contribution to political party and contributions to electoral trust. Only 2 transactions we are covering under 80 GGC. But whether 80 GGB, whether 80 GGC, in both, we're talking only and only about non-cash mode. Irrespective of the amount, the payment has to be made only in non-cash mode. All right, guys. So this is it about 80 GGB and 80 GGC. So with this, you have learned all your 5 sections under the 80G series. So 80G, which is for donations, then you have 80GG, which is for rent for a house, 80GGA, which is with respect to contributions if my SSC does not have PGBP head, and 80GGB and GGC are for political contributions. Please remember one final thing under 80 GGB and 80 GGC. What do you mean by political party? A political party means a political party as per section 29A of Representation of People Act, ROPA. Representation of People Act 1951. Political party means a political party as per section 29A of Representation of People Act. Just be aware of this. And political party means a political party as per section 29A of Representation of People Act 1951. Coming to the last set of sections, we'll be discussing these leftover sections together. First of all, we will be talking about section 80 JJAA. Then we have section 80 QQB and section 80 RRB. Then we'll be learning about section 80 TTA and section 80 TTB. And finally, we have section 80 U. These are our last 6 sections under chapter 6A. Now, over here, if you see, these 3 sections, these are chapter 6A part C sections. These are chapter 6A part C sections. So because they are part C sections, you will get a deduction under these 3 sections only if your assessee files his ITR on time. In your syllabus, you have only 3 chapter 6A part C sections: 80 JJAA, 80 QQB and 80 RRB. So we'll discuss these sections one by one. These 3 sections will be slightly different, and then we'll come to the last 3 sections. Okay, let's take them up one by one. Our very first discussion is going to be about section 80 JJAA, a section which was earlier not very important for the intermediate level. This section used to be asked generally only in CA final examinations, but if you look at the last few examinations, if you look at the RTPs and the MTPs, this section has become the new focus of the examiner. So therefore, we will try to make this section as strong as possible for ourselves. All right, let's begin, guys. Section 80 JJAA gives a very big benefit to the assessees, but it also puts too many conditions on the assessees. So if the assessee fulfills all these conditions, then my assessee will be able to enjoy a big, huge benefit under 80 JJAA. First, let's talk about the conditions. The first condition is that the assessee must be having PGBP. The assessee must be carrying on some business or profession, and he must be carrying on his PGBP in such a way that in the current year, section 44AB tax audit should be applicable to the assessee. You know what is 44AB tax audit? That whole flow chart comes to your mind? Yes. So 44AB tax audit should be applicable to the assessee. So condition 1, assessee must be having PGBP, and condition number 2, his business or profession should be subject to tax audit. Then comes condition 3. The third condition is that the assessee must be having additional employees. Now, what do you mean by additional employees? Additional employees means if you look at the current year last day, like for our examination, our previous year is 23-24, right? So what is 23-24 last day? 23-24 last day would be 31st March 2024. So 31st March 2024, how many employees do we have? And we look at the preceding previous year. What's the preceding previous year? 22-23. 22-23, what's the last day? 31st March 2023. On this date, how many employees do we have? So if you look at 23-24 last day employees, this should be more than 22-23 last day employees. So in the current year, the number of employees should be more than the last year's employee. Like for example, current year last day, let's say we have 100 employees. 22-23 last day, let's say we have some 75 employees. So in 23-24, how many additional employees are we having? We are having 25 additional employees. Are you understanding, everybody? So additional employees indicates current year we must be having a higher number of employees than the last year. Current year we must be having additional employees. But there is a catch. You will not consider every employee as additional employee. For the purpose of 80JJAA, whom will you consider as an employee? Listen, there are some conditions. If you will consider only those employees whose salary is within 25,000 per month. You will consider only those employees whose salary is within 25,000 per month. Those employees should be participating in RPF. All right. Those employees should be receiving salary in specified mode. See, in the whole of chapter 6A, wherever we spoke about the mode of payment, what mode of payment did we talk about? We spoke about only non-cash mode, right? But under 80JJAA, we are talking about specified mode. You know what the specified modes are? Account pay, check, account pay, bank draft, ECS, and any other electronic payment. So under 80JJAA, the payment has the salary which you are paying to the employees has to be within 25,000 per month. Only those employees we will even consider. And they must be participating in RPF, and we must be paying them salary in specified mode. Okay. And how many days should they have worked for us? They should have worked for us for at least 240 days. They should have worked for us. But however, instead of 240 days, just 150 days will also be enough for us if the assessee happens to be in the apparel sector, or if the assessee happens to be in the footwear sector, or if the assessee happens to be in the leather sector. In these three sectors, if the assessee's work, if the assessee's business or profession is in any of these three sectors, then 240 days criteria does not exist. Instead, it is relaxed to 150 days criteria. So these are your conditions. All right, what are your conditions? Condition number 1, assessee must be having PGBP. Assessee must be getting his business or profession tax audited. There must be tax audit under section 44AB. Condition number 3, assessee must be having additional employees. That is current year last day. If you see, assessee should be having more number of employees than last year last day. Okay, but which employees are you even going to consider? You're going to consider only those employees who are getting salary of up to 25,000 per month, and we must be paying them the salary in specified mode. They should be participating in RPF, and they should have worked for us for at least 240 days in the year. If, however, it is apparel sector is nothing but your ready-made clothes sector or footwear sector or leather sector, here 150 days itself is enough. So if all these conditions are fulfilled, then in that case, we will be eligible for 80JJAA deduction. Now, what is this 80JJAA deduction? Let me tell you. Very, very interesting. See, we have additional employees, right? To these additional employees, we'll see how much salary are we paying. That will become additional employee cost for the assessee. See, I'm the businessman. So for me, I'm the person who's carrying on the business. So for me, whatever salary I'm paying to my additional employees, for me it will become a cost. So I'll say, what is my additional employee cost? How many additional employees am I having? How much salary did I pay to them in the current year? What is my additional employee cost? Now, do you agree this additional employee cost will form part of salary or wages in your P&L? So, in your P&L, you have already debited the salary and wages. Do you agree? Yes, come on, tell me, participate, please. This additional employee cost is nothing but a part, it's going to be a part of my salary and wages, which is already going to be debited in the P&L account. So, I've already debited this in my PGBP computation. However, still, 30% of this additional employee cost I am going to get as a deduction across 3 years. So 30%, 30%, 30%, total 90% deduction I will get under section 80JJEE. I have already debited the expense in my P&L. I am again going to get 30, 30, 30 across 3 years. So totally I will end up enjoying 190% deduction. Are you able to imagine how big this benefit is? Whatever is a salary you're paying to these additional employees, you have already debited it in the P&L account. You will again see how much salary have you paid to these additional employees. 30% of that you're going to get as a deduction across the next 3 years. See, once you get a deduction of 30% in the current year, you don't have to check next year whether the employee is still there with you or whether he has left. Doesn't matter. You have enjoyed 30% in the current year. Now next year and the year after that, you will get the balance 30-30, you will get. So next year, even if the employee has left, you will still get this 30-30. In other words, you are going to get 90% deduction under 80JJEE. Only think that 90% I'm going to split across 3 years. So even if in the next 2 years, if the employee leaves us, we will still be eligible for this. It doesn't matter whether he has left or not. I will not even check all that. Once I've enjoyed 30%, I know now that next 2 years, I will enjoy the remaining 30-30 I will enjoy. So this is 80JJEE. Under 80JJEE, condition number 1, my assessee must be having PGBP. Assessee must be getting tax audit done. Condition 2, assessee must be having additional employees. Now, additional employees would be those employees to whom we are paying up to 25,000 per month. They are participating in RPF. We are paying them salary in specified mode and they worked for us for at least 240 days. However, if it is apparel sector, footwear sector or leather sector, it is enough if they worked for us for at least 150 days. We have 4 conditions. If all these 4 conditions are fulfilled, then assessee will be eligible for 80JJEE deduction. Under 80JJEE, we will see what is the additional employee cost. That is, to these additional employees, how much salaries are we paying? So that we've already debited in the P&L account. In addition to that, you will get another 90% of the additional employee cost as a deduction under 80JJEE. This 90% will be split across 3 years. So 30%, 30%, 30%, you will get a deduction across 3 years. Okay. So once you enjoy this 30% in this current year, the remaining 60% you will get in the next 2 years. Whether in these 2 years the employee still is working for you or not working for you doesn't matter. Once you enjoy 30%, the next 2 years you will enjoy the balance 30 and 30 you will enjoy. This was section 80JJEE. 80JJEE, huge benefit because you've already debited the salary and wages in your P&L, and I'm again allowing the same amount for you under 80JJEE. So it's as if you're ending up enjoying 190% of the deduction you're ending up enjoying. Is this clear? Coming to the next section now, your next section is section 80QQB. See, section 80QQB, your next section, this is with respect to royalty income which is earned by authors of books. So 80QQB, what is 80JJEE about? 80JJEE is about the additional employee cost. So whatever is the additional employee cost, 30%, 30%, 30% you'll enjoy across 3 years. Now what is 80QQB all about? See over here, listen carefully, simple section. Assessee has to be an author. He must be author of a book. Now the book could be a literary book or an artistic book or a scientific book, doesn't matter. But however, we're not talking about textbooks. We're not talking about school and college textbook authors. We're not talking about authors of guides. We're not talking about people who've written articles in magazines or newspapers or journals. We're not talking about all of these. These are excluded. So assessee has to be an author. The book can be of literary nature or artistic nature or scientific nature. And because he's an author of a book, he's earning royalty income, right? Now, this royalty income, you will tax for him under which head? You know very well, royalty income is always taxed under the IFOS head, guys. So you will tax it for him under IFOS head, and then you will also give him section 80 QQB deduction. Okay, it's a very simple section. Assessee is the author of a book, and the assessee is earning royalty income. So this royalty income, assessee is going to be taxing it under IFOS head. After taxing it under the IFOS head, assessee will also get a deduction under section 80 QQB. Assessee will also get a deduction. All right. Now here, how are you going to compute this 80 QQB deduction? What's going to be your set of steps? How are you going to compute the 80 QQB deduction? Listen to me. You will first of all see how much is a royalty income. Okay. Now, if this royalty income, it's generally, it's sometimes in lump sum form, and sometimes it's a percentage. All right. Now, if it is a percentage, it has to be restricted to 15%. If it is a percentage, we will restrict it to 15%. All right. Then, if this royalty income is earned from outside India, we will consider only that part of the royalty income which has been realized in India. It should be brought into India, it should be remitted to India within 6 months from the end of the previous year. I'll repeat again. We'll see how much royalty income has your assessee earned. If it is in a percentage form, it has to be restricted to 15%. Then out of this 15%, we'll consider only that part of the royalty income which has been brought into India within 6 months from the end of the year. Of course, this point will come into the picture only if the royalty is earned from outside India. So if the royalty income is earned from outside India, we'll consider only that part of the royalty income which we have brought back into India within 6 months from the end of the previous year. And then to earn this royalty income, we would have incurred some expenses. So we will subtract those expenses and we'll see what is a net royalty income. All right. This net royalty income number will be compared with the maximum limit. The maximum limit is 3 lakh rupees. So this net royalty income number or 3 lakh rupees, whichever is lower, this is going to be a section 80 QQB deduction. Okay, guys. So first of all, we'll have to restrict it to 15%. Then we'll see out of this 15%, how much has been realized in India within 6 months from the end of the previous year. Then to earn this royalty income, in case we have incurred any expenses, we'll subtract those expenses also. We'll find the net royalty income. This net royalty income will be compared with maximum limit of 3 lakh rupees, and whichever is lower, this royalty income or this maximum of 3 lakh, whichever is lower, that is what we will allow as a deduction under section 80 QQB. Simple section. Assessee is an author. Assessee has received royalty income. We will first tax the royalty income under the IFOS head, and then the same royalty income will also be eligible for 80 QQB deduction. Keep in mind 3 steps. Step number 1, we'll first restrict it to 15%. Then out of the 15%, we'll see how much has been realized in India within 6 months from the end of the previous year. And from that, we'll subtract whatever expenses we have incurred to earn this royalty income. And then finally, we'll compare the net number with the limit of 3 lakhs. So out of these two, whichever is lesser, this is going to be our section 80 QQB deduction. Now, if you've understood 80 QQB, 80 RRB will be more or less the same, just one small difference. I'll discuss 80 RRB with you. I'll copy this first. One second. See, listen. Our next section, we're talking about section 80 RRB. Now, under section 80 RRB also, here also we're talking about royalty income. But here assessee is not an author. He is not an author. Instead, he's an inventor. He has invented something, and that invention is also patented in his name. So under 80 RRB, your assessee is a patentee. Assessee is a patentee, as in he has a patent which is registered in his name. He has invented something, and that invention is also patented and he has a patent in his name. So he's a patentee, and from this patent, whatever royalty income he earns, this royalty income is again going to be taxed under the IFOS head, and apart from that, assessee will also get 80 RRB deduction. Okay. Now, even over here, the steps will be a little similar, but there will also be one small change, and that is here you don't have to restrict it to 15%. In 80 QQB, we restrict the royalty income to 15%, right? But in 80 RRB, we don't restrict the royalty income to 15%. We take the royalty income, whatever the amount is, we'll take it as it is. We'll take it as it is, and then what we'll do is we'll see how much has been remitted to India within 6 months from the end of the year, and then we'll subtract the expenses which we've incurred to earn the royalty income. That will be a net number, and even over here the maximum is going to be 3 lakhs. So everything else is exactly the same between 80 QQB and 80 RRB. What are the differences? If you have to compare section 80 QQB and section 80 RRB, if you have to compare these two sections, there is a very thin line of difference between the two, but it's not confusing also. 80 QQB is for author of books. 80 RRB is for patentees of inventions. Under 80 QQB, the maximum royalty rate allowed is 15%, but here in 80 RRB, we don't have this 15% criteria. Apart from these two differences, the entire section is exactly the same. Even over here, we'll consider only that part of the royalty income which we have remitted to India within 6 months from the end of the year. Even over here, whatever expenses we've incurred to earn this royalty income, we'll subtract. Even over here, our maximum deduction is going to be 3 lakhs. Okay, so with this, you've learned all your 3 sections which are a part of chapter 6A, part C. You've learned about 80 JJAA, and you've learned about 80 QQB, and you've also covered 80 RRB. Now coming to the next 2 sections, we have section 80 TTA and section 80 TTB. Let's discuss these 2 sections. We're comparing section 80 TTA and section 80 TTB. See, out of these 2 sections, if you see, 80 TTB is more beneficial. So we'll discuss about 80 TTB first. Under 80 TTB, your assessee has to be a senior citizen or a super senior citizen. Assessee has to be a senior citizen or a super senior citizen. Okay. Now, this is your first condition. And second condition is that assessee must be having interest income. Now, interest income assessee must have earned from BCP. B stands for bank, C stands for a cooperative bank, and P stands for post office. Now, this interest income can be any kind of interest income. It can be savings bank interest income. It can be FD account interest income. It can be recurring deposit interest income. It can be any kind of interest income, just that the interest income has to be from BCP. So 2 conditions. If both these conditions are fulfilled, we'll see whatever interest income the assessee has received, how much interest income has the assessee earned. This subject to a maximum deduction of 50,000. So whichever is lesser, this is your 80 TTB deduction. That's all, as simple as this. So under section 80 TTB, condition number 1, assessee has to be a senior citizen or a super senior citizen. Condition number 2, assessee must have earned interest income. Interest income should have been earned by the assessee either from a bank or from a cooperative bank or from a post office. It can be any kind of interest income. Now, whatever interest income assessee has earned, that interest income subject to a maximum of 50,000, this is going to be allowed under section 80 TTB. Okay. So 80 TTB is all about interest income. Now coming to section 80 TTA. See, I'll first copy the same thing as it is so that you can see exactly where the differences are between these 2 sections. Over here, if you see, assessee can be an individual or assessee can be a HUF. Individual or assessee can be a HUF. But if assessee is an individual, assessee is that individual to whom section 80TTB is not applicable. Because first you will try to apply 80TTB. Only if 80TTB is not applicable, only then you will think about 80TTA. So who is the individual under 80TTA? The individual under 80TTA is an individual to whom 80TTB was not applicable. So either assessee is an individual to whom 80TTB was not applicable, or assessee is a HUF. Assessee has earned interest income again from BCP. But here, under 80TTA, there's a small catch. We're talking only about savings bank interest income. We are not talking about FD interest income. We're not talking about RD interest income. And here, the maximum deduction is 10,000 and not 50,000. So the maximum deduction under 80TTA is 10,000. Now you understood why I'm saying 80TTB is more beneficial, because under 80TTB, your maximum deduction is 50,000. Under 80TTA, your maximum deduction is only 10,000. So that is why we first try to fit ourselves into 80TTB. Only if 80TTB does not apply to us, only then we will think about section 80TTA. All right, one second, it got disrupted. Now look at this now. Okay, so this was our entire discussion on section 80TTA and 80TTB, but we're also going to do a sort of a comparison between these two sections. That's how we'll get better clarity. 80TTB, keep in mind, assessee is a senior citizen or a super senior citizen, all right? And 80TTA, assessee can be an individual or assessee can be a HUF, but which individual? Only that individual to whom 80TTB is not applicable. Only those individuals will fit under 80TTA. And remember, 80TTA does not cover FD interest and recurring deposit interest. All right, 80TTB covers all interests. 80TTB, the maximum limit under 80TTB is 50,000. 80TTA, the maximum limit is 10,000. All right, guys. Now listen carefully. I'll try to first differentiate for you 80TTA and 80TTB. That will give you a very good clarity. Some points which you might not even have thought of will get covered under this differentiation. See, tell me what are the differences that you know of first. Point number 1. 80TTA will cover only savings bank interest. But 80TTB will cover savings bank interest also, savings account interest also, FD interest also, RD, recurring deposit, RD's recurring deposit interest also. It will cover all interests. Then the second difference, 80TTA, what's your maximum limit? 10,000. But 80TTB, what's your maximum limit? 50,000, right? Then what are the other differences that you can think of? 80TTA and 80TTB, if you compare these two sections, 80TTB will apply to only those individuals who are either senior citizens or super senior citizens, but 80TTA will apply to those individuals who are not senior citizens and not super senior citizens. So in simple words, 80TTA will apply to those individuals who are not covered by 80TTB. I can say that it will apply to those individuals who are not covered by 80TTB. Leftover individuals come to section 80TTA. Then what about HUF? 80TTA applies to HUF also. But does 80TTB apply to HUF, guys? No, it does not apply to HUF. 80TTB applies only to those individuals who are senior citizens or super senior citizens. It does not apply to HUF. Then the fifth difference, tell me, does 80TTB apply to non-residents? Answer. Does 80TTB apply to resident, non-resident both? No. See, 80TTB applies only to senior citizens, super senior citizens. Now, who are senior citizens, super senior citizens? They must be individuals, they must be residents, and they must be at least 60 years. So they have to be residents, guys. So therefore, 80TTB will apply only to residents, will not apply to non-residents. But 80TTA will apply to resident, non-resident both. Are we clear? Yes, these are the differences between 80TTA and 80TTB. So 80TTA is covering only savings bank interest. 80TTB is covering all interests. ADTTA maximum limit is 10,000. ADTTB maximum limit is 50,000. ADTTA covers those individuals to whom ADTTB is not applicable. ADTTB covers only those individuals who are senior citizens and super senior citizens. ADTTA also applies to HUF. ADTTB is not applicable to HUF. ADTTA will apply to resident, non-resident both. ADTTB will apply only to resident assessees. All right, guys, this was a very good differentiation. This is the sort of conceptual clarity which you should be having at your intermediate level. You're understanding this sort of a differentiation. If you try to do this, you're interlinking various sections, you're interlinking various concepts. Whatever is a scope for confusion is getting sorted even before you enter into the examination hall. Otherwise, these kind of confusing points, our mind starts thinking exactly during the examination. So when you've done this sort of, a clear-cut comparison beforehand, you're not leaving any scope for confusion. And this is the sort of differentiation that you should be doing in multiple places. This is what I've done for you. If you see, in so many places in our entire discussion, we've done these sort of comparisons. They will not ask us to compare between two sections. They're not going to ask us to do differentiations and all. Why do we keep doing this? In every chapter, if you see, I've made you do this differentiation in so many concepts. The reason is when we do this differentiation, when we do this comparison, we start thinking in ways in which we would not have thought about earlier. And whatever is a possible confusion, we're eliminating it right away, even before, we start working out questions. So when we work out questions, you have a very good clarity about the sections and there is absolutely no confusion even left. So these were your two sections, ATTTA and ATTTB. And now coming to one final section under your chapter 6A discussion, which is section ATU. Now you're aware of section ATU. We spoke about it some time back as well when I was discussing with you about section ATDD. Do you remember? What does section ATU talk about? What does section ATU talk about? ATU talks about cases where the condition number 1, the assessee has to be a resident individual. And this resident individual is disabled. So ATU comes into the picture when the assessee himself is disabled. That is where ATU comes into the picture, where assessee himself is disabled. Now, if these two conditions are fulfilled, the assessee will get a flat deduction under section ATU. The numbers are exactly what you've learned even in ATDD. See, very simple. If assessee himself is disabled, we'll have to see who is disabled. If assessee himself is disabled, we will think about section ATU. If assessee's dependent relative happens to be disabled, then we will think about section ATDD. But whether it is ATU, whether it is ATDD, the numbers are going to be the same. In both you have flat deduction. You'll have a flat deduction of 75,000 if the disability is at least 40%. But however, if the disability happens to be at least 80%, then it becomes a case of severe disability. And in severe disability cases, how much deduction will you get? Here you will get a flat deduction of 1,25,000. Understanding? This is it. This is it about a discussion with respect to section ATU. Understanding? So ATU and ATDD, in both the sections, the numbers are the same. In both the sections, if you see, the numbers are 75,000 and 1,25,000. In both, we have flat deductions. The only thing is, if assessee himself is disabled, we think about ATU. And if the dependent relative is disabled, we think about ATDD. Okay, so with this, you're done learning about all the sections under chapter 6A. Now, before I close the learning part on chapter 6A, I want to give you one final summary about the mode of payment. See, mode of payment, we've spoken about the mode of payment in which sections? See, not every section talks about the mode of payment. In which sections have we spoken about the mode of payment? Section ATD. This is where we spoke about mode of payment for the first time. Then where else? We spoke about the mode of payment in section ATG also. In section ATGGA also. Then we also spoke about the mode of payment in ATGGB and in ATGGC. And finally, we spoke about the mode of payment in ATJJAA. These 6 sections, guys. There's a reason why I've written them in these 3 parts. 80D, which talks about medical insurance premium, 80GGB and GGC, which talk about political party contributions. Here, irrespective of the amount, irrespective of what the amount is, the payment has to be made in which mode? The payment has to be made in non-cash mode. We don't even talk about the 2000 limit over here. Irrespective of the amount of payment, you have to make the payment in non-cash mode. But 80G, donations. And what is 80GGA? 80GGA, remember, scientific research, National Fund for Rural Development, National Urban Poverty Eradication Fund. In these two sections, we say that up to 2000, you can make the payment in any mode, and more than 2000, you have to make the payment only in non-cash mode. And in 80JJAA, what do we talk about here? Here we say that the payment has to be made in specified mode. So all the other sections in in chapter 6A, wherever we talk about the mode of payment, we talk only about the non-cash mode, right? But however, in 80JJAA, this is the only section where we talk about the specified mode. You know what the specified modes are? Account pay check, account pay bank draft, and ACS. Okay, so this was your final summary on the modes of payment. With this, we are done with the learning part, the conceptual learning part of your chapter 6A, all the sections we've spoken about. So if we have to give ourselves one final summary, let's talk about the section numbers that we've learned under chapter 6A. 80C, which talks about life insurance premium, PPF, all that. Then we spoke about 80CCC, annuity plan of LIC. We spoke about 80CCD, which talks about National Pension Scheme, also called as Atal Pension Yojana. Then 80CCE, which talks about 80C plus CCC plus CCD subsection 1. Then we spoke about 80CCH, the new section which talks about Agniveer and Agnipath scheme and all. Then we spoke about 80D series, where we learned about 80D medical insurance premium. We learned about 80DD, dependent disabled relative. We spoke about 80DDB, where we learned about disease, specified disease, rule 11DD. Then we discussed about section 80E, interest on education loan, 80EE, housing loan interest, 80EEA, which is also housing loan interest, and 80EEB, which is vehicle loan, electric vehicle loan interest. Then we learned about the 80G series, where we learned about 80G donations, 80GG rent, 80GGA, which is your scientific research expenditure, contribution to outsiders, National Fund for Rural Development, and National Urban Poverty Eradication Fund. Apart from this, we spoke about 80GGB and 80GGC, wherein we learned about the political party donations. Apart from all these sections, we also learned about the extra sections 80JJAA, then 80QQB, 80RRB, and then we learned about 80TTA, 80TTB, and 80U. Never forget, you have 3 sections belonging to chapter 6A part C, 80JJAA, 80QQB, and 80RRB. So these are the sections that we have covered under chapter 6A. Perfect clarity? Yes, guys, confident with all the discussions, confident with all the sections? I'm hoping that as of now, you are confident enough to at least you should be having a sort of conceptual clarity that yes, I've understood all the sections really, really well. Coming to the last part of our chapter 6A discussion, just one final thing. If your assessee is following 115 BAC, that is the default provisions, then 80 CCD subsection 2, remember employers' contribution to NPS, then 80 CCH subsection 2, the central government's contribution to the Agnipath Corpus Fund, and 80 JJAA, the section that we just saw. These 3 sections assessee will be able to enjoy if the assessee is following 115 BAC. But all the other sections, assessee will not be able to enjoy. Alright, so if the assessee is following 115 BAC under chapter 6A, only these 3 sections assessee will be able to enjoy. And one final point, one small point only, be careful about this. See, like for example, if I'm making a payment towards PPF, okay? It doesn't matter whether I make the payment out of taxable income or whether I make the payment out of exempt income. So basically, to make the payment, I need money, right? If I'm making payment towards PPF, I need money first of all. So I should have earned the money. So whether let's say I earned agricultural income, From agricultural income, I'm taking money and I'm making payment towards PPF. It doesn't matter. From where did I take the money and make the payment? Did I take the money out of taxable income? Did I take the money out of exempt income? Doesn't matter. What matters is I contributed to PPF, so I will enjoy ATC. Whether I took the money from taxable income bucket, whether I took the money from exempt income bucket, doesn't matter. But it matters only in these three sections. In your syllabus, it matters only in these three sections, ATCCC, ATD, and ATE. In these three sections, it is important that you should have taken the money only out of taxable income. In these three sections, it is important that you should have taken the money out of taxable income and not out of exempt income. All right, that's it. So with this, we'll close our entire discussion on chapter 6.